Hello and welcome to day 2 of ETMarkets Global Summit 2021. As you all know, ETMGS is usually held in Mumbai where we interact with Dalal Street's best. But this year we have gone completely virtual. After a great first day yesterday where we heard from many industry leaders such as Jim Rogers, KV Kamath, Swaminathan Iyer, Sonal Verma and Dr. Sangeeta Reddy, we have another busy agenda ahead. We kick off today's event with a keynote address by someone who does not need any introduction. He is best known for coining the acronym BRICS, the Next 11, and Mint. The Right Honorable Baron Jim O'Neill of Gatley is an authority on emerging economics and currency markets. A former chairman of Goldman Sachs Asset Management and former Treasury Secretary of the UK, O'Neill is currently the chairman of the Council of Chatham House. In this speech, he will be addressing a key worry. Will 2021 be a year of taper tantrum? Baron O'Neill, I'd like to welcome you to ETMarkets Global Summit. Ajay Sharma from ET Now will be joining you for a Q&A round right after this address. Over to you, Jim. Hi, Jim.
I think I was muted.
Oh, yeah, we can hear you now.
Right, let me start again. Thank you very much for that very flattering introduction.
It's great to have you.
It's a huge honor to be here. You've set me a very difficult question. I will try to give a more detailed answer, but for those that don't have much time or patience, the answer is I don't think so in 2021. Probably it's a bigger problem for 2022. And let me explain what lies behind that for the rest of my time before we turn to Q&A. I guess there are 5 things I would like to outline as part of my substance behind that brief answer. And the first of all, I guess, before I go into any of the 5 parts, I should probably say, as an economist, the true answer should be that we don't know the answer to any of these things. As this crisis has demonstrated yet again, as we saw in 2008, there are huge things about aspects of the world that are extremely unpredictable, and none of us have any knowledge as to when these things happen or quite what the path after these events happen end up being. But we all have to try our best and use the tools that we are trained and experienced to use. So with that in mind, let me try to outline my main ideas. So first of all, I'm in the camp that thinks in 2021 we will probably have, particularly in the second half of the year, a quite vigorous economic recovery. And let me try to give some substance to that. First of all, if you really look at the world as a truly global unit and think of it as an average of all the different major countries and regions, economic activity in 2 places in particular, and to some degree, some others behind it, but in particular the US and China, tend to typically drive what is the performance of the world economy. And as we've just seen with the estimates of the latest data in China for December, turning the year into 21, and for the average of the year, miraculously on some levels, China actually ended 2021 from a GDP perspective actually stronger than it did before the pandemic started. And China these days is, of course, the second biggest economy in the world in nominal GDP terms. And in PPP terms, it's the biggest. And it looks to me as though China's starting 2021 growing by something in the vicinity of 6.5% to 7%. And it could be China's best growth rate, ironically, for a long time. The United States, particularly talking on the morning after the coincidental, and congratulations for the timing to you guys in this regard, to coincide with the inauguration of the new president. But this morning and later today, I suspect we'll see a lot of Wall Street research firms and sell-side houses revising higher their US economic growth forecast, primarily because of the likely fiscal stimulus that is coming pretty soon. And the United States, in my opinion, has a good chance of growing by also levels of GDP growth that we've not experienced for a very long time. And if you put the two of these countries together, certainly based on the last decade, they account together between them something close to 3/4, if not more, like 80% of all global growth. And then in addition to that, you got to look at India as the second most important of the BRIC countries in terms of size. And of course, some other important developed economies, perhaps, particularly the EU. And their growth might not be as vigorous as in China and India, China and America, but I think in India, depending on what I'm going to talk about next, vaccines, India could have a big recovery from its weak economic performance in 2022. And so in that sense, I think it's important to understand, and linking it into my second point, that the nature of the 2020 crisis is really, even by the standards of any crisis, quite unique, insofar as most of it was caused by a deliberate closing down of many aspects of our economies. And I know it's obvious, but I think when a lot of people talk about what will now happen and the economies and society in general, people seem to be forgetful of the fact that during this closing down of the economy, the personal savings rates in many, many countries has risen to extraordinary levels, including in places like the UK, where I live and I'm from, and the United States, which we are just simply not used to. And that is because most of us haven't been able to spend on many of the items we would normally choose to spend on. And even with the challenges of working, and in some cases, many cases, unfortunately, people losing their jobs, the fact that savings rates have risen so sharply, in my opinion, is a very important part that I think some of the pessimists for 2021 are missing. And I say that because going back to my opening comments of I don't really know, and nor does anybody else, what really matters, in my opinion, is the speed and success and efficacy and usefulness of the vaccine rollouts, which has just got underway in recent weeks. And I think it is quite likely that those countries that have the greatest success in rolling out vaccine coverage as early as possible are likely to see the fastest economic recoveries, particularly early on, because of course it will allow their governments to start opening up parts of their domestic economy. But crucially, it will also allow individuals and consumers to have a lot more confidence that there could be an end to this dreadful pandemic. And with it, encouraging them to start reducing these very high levels of personal savings. And in that context, I think there could be a very strong rise in personal consumption in many, many parts of the world in 2021, particularly from spring onwards in the Western world, and maybe in some parts of the rest of the world. And as again, I emphasize, aspects of it are already taking place in parts of North Asia, particularly in China. But I do emphasize a lot of this crucially depends on the success, on the ongoing success of the rollout of vaccines. Another important thing to say in this context, reading the overnight news as I do every morning when I wake up, I think it is quite possible that sometime in the next 24 hours, we get news of another very important vaccine that has passed stage 3 trials. And importantly, in this case, the J&J one, if it does, this is one where there is no dispute about the number of dosages. It's only one. And of course, that could be even more powerful for many parts of the world, particularly crucially for parts of the so-called emerging world. And I'll come back to that issue in a minute. Third point for me to say is, and this goes to the heart of the question I've been asked, what is going to happen to monetary and fiscal policy? And I think certainly talking the morning after Biden's inauguration, I think we know fiscal policy in the major economies is going to remain at least as accommodative as it has been, and possibly even more. And from a long-term perspective, it may well be that in the future there are going to be costs to such generous fiscal policy, either in the form of higher taxes or reduced expenditure, possibly also putting pressure on the allocation of resources and challenging the private sector's investment behavior, and possibly sowing the seeds of future inflation. And these are all really important questions for the future, but I don't think they are questions for 2021. And the only question is whether other parts of the world will actually think about what Biden is doing and choose to take some longer term risks by adding additional fiscal stimulus in their own countries. And I would not rule out that possibility in some places. And then even more crucially, because of the interconnection, of course, of monetary policy to financial markets, what is the Federal Reserve going to do? What is the Chinese central bank going to do? What is the ECB going to do? And in my opinion, the answer at the moment appears to be pretty clear. They are going to remain just as friendly as they are, even with an initial vigorous economic recovery. Now, I am sure at times, particularly on days where, if I'm right, we see very strong economic data reported, bond markets and some other markets might start to get concerned that the recovery is so vigorous that central banks will start to move to take away some of their generosity. But I think unless we see signs of growth even stronger than the optimistic numbers I believe, and with it, importantly, signs of inflation picking up, I read the message from central banks in the most important parts of the world. They are not going to raise interest rates or start removing this monetary stimulus until not only have we got growth very strong, but we have recovered some of the impetus of the growth that was lost in 2020. And that is probably the absolute key to whether we go through a sustained period of taper tampering or taper tantrums. Let me say cover the two other areas quickly, and then I'll stop. The fourth thing, which it seems to me the markets are correctly focusing on overnight, and hence why we have new highs in equity markets almost everywhere, because in addition to the prospects of strong recovery and continued very generous monetary and fiscal policy, it's quite clear that we are essentially in the early stages of reversing the American insular push of the past 4 years. Already, Joe Biden has signaled that the US is going to return to the WHO, which in view of and this will touch on another sub-point I want to make in a minute, in view of the crucial need to make sure we get equitable vaccine distribution to all parts of the world, this, in my opinion, will be the basis of an important breakthrough in an area which has been one of the most disappointing aspects of the COVID response policy in the health area. And I would expect in coming days and weeks, we see more and more signs of the Biden administration wanting to recommit America in the middle of global policy cooperation. And I would not rule out the possibility that they try to encourage and persuade Italy to actually have an emergency G20 meeting earlier than the one that is planned typically for the middle of the year, in order that the Americans can send out this message of constructive support to the rest of the world. I hope I'm right, and it seems to me the markets are certainly anticipating some of that kind of flavor if you look at how they've responded to the comments of Biden in his inauguration speech and the announcements that have been made since. The last thing I want to just finish on briefly before I turn it over to hopefully some Q&A. If I put all of this together, especially if I'm right about central banks remaining so friendly, this is an almost textbook perfect support environment for that of so-called emerging markets. In fact, when I really look at it closely, it is so scarily positive, it does make me think something must go wrong at some stage, because life is never that straightforward. But if you combine a strong, vigorous cyclical recovery that is supporting commodity markets, a very stimulative monetary and fiscal policy, and a behavior of the dollar that is, let's say, not strong, but is either stable or declining, these are all historically extremely supportive factors for so-called emerging markets. And I certainly believe over the early part of 2021, as we've seen, this is something that is set to continue, which should be a very good backdrop for many financial markets around the world, crucially, including for all of you there in India. At some point, this nice scenario won't persist. My suspicion it's going to be a bigger issue for 2022 than it is certainly for 2021, and especially the early weeks and months. And so with that, let me stop there. And thank you again for asking me to talk. I hope I've given some provocative ideas, and I look forward to trying to answer any questions that come my way. Thank you very much.
Right. Jim, can you hear me? This is Ajay here.
I can hear you. Yes, I can hear you.
Great. Good morning there in UK, and good afternoon here to all our viewers who are listening to this very interesting discussion. I'm delighted to be speaking with Jim O'Neill today. Jim, perhaps the reason why we thought about getting your views on this particular topic is once bitten, twice shy. This time, we all want to understand what is the hypothesis, when exactly will market start getting nervous, because compared to previous crisis, this time round, even central bankers across the world have actually thrown many more times the money to the markets for a health crisis. Actually, it was not a financial crisis. Financial crisis was the aftermath of forced shutdown, as I just said. So people want to understand what would be the signs. First of all, I'd like to thank you that at least you have soothed a lot of nervous phrase that 2021 it's not happening. But what would those signs be which investors who are listening to us right now and even across the world would want to watch out for, to understand that perhaps the easing which has been done, record amount of easing, now may come to a halt?
So let me say a couple of things. So first of all, I don't know. And anybody that claims confidently they do, I wouldn't listen to them. Second thing I would say in that regard, I think everybody, if they can, has to be very alert to obvious things that could become issues, or actually try and just stay away from the noise and just watch the underlying messaging from policymakers, particularly the Federal Reserve Board, very clearly. As somebody that's not so involved on a daily basis in financial markets as I once was for 30 years of my life, to be really honest with you, I learned through time it may give me an advantage, because I don't get so carried away about every little twist of developments. And there are many days where things are just kind of random and they don't really mean anything. The third thing I would say in this regard is the key thing to watch for is probably inflation. And if we saw signs that inflation, that we've all decided now after many, many years of it just never picking up whatever was happening, if for some reason inflation were to start picking up, that would be a big warning sign that central banks are going to have to change the tune. And that is certainly what I'm keeping an eye on. So far, there doesn't seem to be too much to be worried about, but that is what I would watch.
Mm-hmm. Jim, in fact, I was just, before talking to you right now, I was preparing for our chat and I was looking at some previous charts, be it ECB or by the US Fed, as and when more and more, QE was being added, inflation did, contained, was remaining in a very narrow range. It did not budge. And yields started going down. And now we are talking about negative yields also in some areas. What does it actually do to financial markets' health? Or does this copious amounts of money actually make it more fragile?
It's a very interesting question. And I do think over the course of the next 5 years, as opposed to this year, below your question are some very important philosophical and cultural issues. The most important thing that QE has done and continues to do is mean that overall financial conditions continue to ease. And by overall financial conditions, I mean a combination of equity prices, bond prices, and in many parts of the world, given the consequences for individuals' wealth, also house prices. It's quite interesting, even in somewhere like the UK, despite a near 10% decline in the economy, we saw a very strong rebound in house prices in the second half of last year. Remarkable. And the signs of it taking place in some parts of the United States too. And all of this, and going back to my life when I was so active and the chief economist of Goldman Sachs, I used to use, in fact, I helped create financial conditions indices to be a leading indicator of GDP. And that's what QE has done. The downside, or the very problematical part of that, is of course on an individual basis, the biggest winners are those that have access to wealth because the value of their wealth rises so much. And over the past decade, despite enormous social issues in many parts of the West, for those people that have owned bonds and equities, it's close and possibly been, particularly for the US markets, the single best decade for owning assets ever. And of course, this probably relates to the perception as well as the actuality of some of the inequality issues that are going on around the world. And at some point, particularly now we have a democratic government in the United States, but because of the rising populist mood in some countries, there is a good chance this is going to lead to not necessarily a backlash, but if it doesn't result in higher taxation for the higher paid or higher incomes, it will result in a significant backlash towards aspects of how financial markets interact with the rest of society. And I think this is a very important challenge for many of our policymakers, in addition and beyond the challenge, the very enormous challenges they have navigating us through this pandemic. And there could be a danger, and I'd put this in the 2022 dangers, that because of these kind of social issues, that not only do they choose to start trying to pursue ideas like wealth taxes and other significant taxes, but they actually try to curtail some of the ways in which financial markets behave because of the broader populist view about these issues.
Jim, I'm just deviating for a moment, but there's a very interesting insight which you just shared, and which is that savings rate across economies in the world are actually rising. You spoke about UK and US, but I must share with you a survey outcome just 2 days back. One of the top 4 largest insurers in India also conducted a survey in which similar insights came out, that savings rates are going up and people are just wanting to jump into financial assets, which they were not so inclined towards. India has been lovers of gold and real estate for decades now. That seemed to be changing. When you take this point on the one hand, on the other hand, yields, yield chasers from developed markets looking for positive yields, does it make a case that the emerging market basket, which you have observed from very nascent stage of development, may have a prolonged case of or a durable good environment, or that's too much to ask for?
I sort of feel very nervous when I hear you ask that, because the reason why is because I'm very nervous about the answer I give you. The answer is yes, but it, as I said towards the end of my formal remarks, I don't think you could put together a better set of circumstances for those that currently face emerging markets. And that's without thinking about, let me call it, the flow aspects of how these high levels of personal savings travel through insurance companies and pension funds into investing in markets. And if you put that on top of everything I said, it is a truly spectacular environment for financial markets. And in particular, those that offer a yield or better return. And interestingly, in terms of equities, that even though I think we're talking on a day where the Indian indices have also hit record highs, even though these things are happening, the relative valuation of emerging markets compared to the United States is still quite subdued. And so there's a very strong chance that this is going to continue. But I know, having had over 30 years professionally in financial markets and now getting on for 40 looking at them, these things don't go on forever. And something will come along to stop it. And when it happens, it'll probably be a bit of a mess. But I think for the foreseeable future, it looks like a very supportive environment.
No, thank you very much for cautioning in a positive way to all our viewers and people who are attending it. Jim, I want to change, track and talk about valuations in general. Some of the people who've been practicing investment management in professional manner, your friends across the world, the Ray Dalios, the Howard Marks, batch of people, if I may say that, have been cautious on the market for several years now. Because it appears that the Robin Hooders and the millennials across the world, they haven't seen inexpensive valuations, and they were born in a bull market. So they continue to push money into the market. What do you see? How do you see, as an economist, as a rational thinker, to this phenomenon?
That is it. I was hoping you wouldn't start asking me these kind of tough questions until towards the end of my time. It's a very interesting question. Let me say a few things about this. First of all, I read, you mentioned Howard Marks. I read, as I'm sure you might have done, this very interesting letter he published recently about growth versus value. And it was fascinating. And it's something I think about a lot in terms of some of my own personal investments, because I invest quite actively in early stage companies, which you hope are growth companies. I could talk for hours about this, but let me say 3 or 4 things, which slightly contradict themselves. First of all, I'm a strong believer that you can never ignore valuation. Ultimately, valuation is what is the linchpin of all markets. Even things like currencies and oil, but in particular, obviously, for equities and bonds. And it doesn't mean that they drive markets. So as we've seen, expensive markets can become more expensive until they don't. But I never personally ignore them. And as I've actually done with my own modest investments and behavior recently, the more expensive markets become, the more one should be careful. Because secondly, I have seen, and I do know, is that when markets turn a trend, it is typically the ones that have become very expensive that suffer the most, because of course they're the ones that have attracted the most money and everybody gets out of them. And I think you can see, if you look closely at what's happened since Biden won the election on November the 20th, there are already some signs of some important sector rotation going on. So tech hasn't been quite as dominant in the US markets leadership. Finance has made a big recovery, and that could be the beginning of warning signs of something more broadly. Third thing I would say in that regard, and I think this is crucial, and it's something I learned a long, long time ago, but it's just so hard for anybody as an investor. If you look over the long term, and by this I mean decades, I think those investors that can act quickly at true points of inflection and so either stop themselves losing a lot of money very quickly and or protect the money they've made are typically the ones that perform best over the long term. And I often say to people in that regard, if I were younger and had the hunger and I had the ambition to just earn a lot of money, I would be tempted to start off a fund that I'd call it Passive Plus, where essentially my main stance would be to just go with the general markets most of the time. But at crucial points of inflection, you have to be very active, both in terms of selling and buying. And you know, that's the kind of conceptual way that I look at the world. And I think that's what will still determine the best investment returns over the next decade.
Mm-hmm. Great. Jim, the other point I wanted to, before taper tantrum risk arises on or comes on the table for investors across the world, at least in India, I've observed that it's not just India which is taking reforms, but many countries across the world are taking reforms to invite global flows. Middle East is opening up. Many other countries are opening up in the emerging market space. Mm-hmm. China is turning its rudder from an export-oriented, infra-oriented economy to consumption. That can also suck away a lot of global liquidity. So, or that will also be an issue which many emerging markets need to be cognizant of, is it not?
So I think, you add to something that's going through my mind as we're chatting, linked to thinking of the risks and taper tantrums. It would be the case that if these personal savings rates fall dramatically, and if it's going more and more into consumption, that could become a particular issue for the bond markets as soon as we get a slight signal that central banks are going to stop being so supportive. And of course, the bond and equity markets relate very closely. I would imagine equity markets are a better place to be than bond markets. But as somebody that goes all the way back to the 1980s and experienced 1993-94, which is really the only savage bear market in bonds we've seen in the past nearly 40 years. Once these things happen and happen quickly, they can cause a lot of turmoil. And at some point that will happen. And I basically believe, because of the environment post-COVID and the economic loss of last year and the way central banks are, that's not going to be soon. But I'm always alert for it, because I lived through that in 93, 94. And even if you saw it coming, it was pretty hard to be away from some of the damage that happened on the back of it.
Jim, how are you analyzing the on-ground health of the US economy, the European economy? Because stimulus is one thing, but on ground, are things coming together or are they remaining weak? What are your thoughts?
So it's a very, obviously this is another hugely important question that I could spend hours talking about. At the core of an answer to this for somebody like me would be the notion of never letting a crisis go to waste. I think about it a lot as it's influenced my career. In fact, as I think and perhaps some of your viewers and listeners know, that actually the whole idea of the BRICS came out of my head in the days of the straight after the crisis of 9/11, and that changed the whole of my professional life. What's important when thinking about some of the Western economies, and for that matter others, is whether the policymakers and their advisors have thought about the circumstances in which COVID has happened, as well as smart ideas to do things differently. Because the second thing to say is central to that is, of course, since 2008, we've witnessed an ongoing era of weakness in productivity in many Western economies, whether it be the States, whether it be the UK, the whole of the G7 and beyond. And what would be good to see is from this crisis, and maybe aspects of the whole more flexible way of working, with service sector people being able to spend more time working from home and many issues that go with that, is whether we're now going to actually embark on a period where we truly use many of these modern technologies, like the one we're doing now, in order to boost our productivity. The airline industry won't like it if we don't all travel in the way we used to do before for business, but it's probably the case in terms of greater productivity if we didn't. When I go back to thinking of my life at Goldman and the amount of times I flew around the world just for internal meetings, this technology shows you don't need to do that, at least all the time. And I think there's very important messages for Western policymakers in this regard. It's complicated because of the social structures that existed before, and of course, the huge domination of urban commuting life. But I think if policymakers are smart, and you're right to imply this with your question, they need to think beyond just fiscal and monetary policy in terms of the medium term, and doing something to raise the productivity performance of their countries, because ultimately it's that boosts the change in real wages, and it's that which is crucial to greater shared economic prosperity for people's citizens.
Mm-hmm. And even perhaps immigration policies, if some say, could have a big impact on growth.
In that sense, I can't, now that you raise that, I encourage all of you that can get an ear with the apparently planned visit of Britain's Prime Minister to India to remind him of that policy when it comes to the UK.
Sure. I think before that, our own Prime Minister would be scheduling a visit to UK soon for some of the other meetings, I'm told. Okay, everybody across the world right now, including India, especially the investing community, and many of us who are listening to you here, are basking in this wonderful sunshine of a bull rally here. I would like you to at least draw attention of these guys towards the burgeoning balance sheets of Fed, ECB, or even the actual debt position of many of the large economies, which are at record highs, and how this also poses a risk at some point in time.
I mean, here's an answer that I should particularly strongly say, I don't know. Every time I hear this question, I immediately think about Japan. I came into the world of financial markets at the start of the 1980s. And by the time that decade was over, Japan's economic miracle had finished. Although even through much of the early 90s, people were still talking about Japan becoming the biggest economy in the world. But we all know that in the early 90s, Japan started to get into a serious financial mess, which laid the foundation for their QE, which Japan has been stuck with ever since. And I say all of that because, as I'm sure you know, and many of your participants know, throughout that period, some of the most successful people in the world were convinced that the Japanese bond market was going to collapse because of Japanese debt. In fact, as I say it, I think of some very well-known investors that were literally regarded as they should have been, the most important macro and stock selecting investors in the world. And the amount of money they lost trying to short the Japanese bond market repeatedly for many years was absolutely enormous.
The reason,
and I think I say all of that because it's not obvious. You know, it used to be the standard view, and there's some academics that continue to publish many important pieces this saying that debt to GDP initially above 60% and then above 80% would be really bad for a country and its markets. But Japan has demonstrated that that is not necessarily the case. And this is a country that also has very weak growth potential because of its demographics. And I say all of that because the second part of answering you, and it's something I've been, let's call it almost campaigning for here in the UK, is I think a very attractive policy solution for countries is instead of pursuing inflation targeting, is actually to switch to a more formal nominal GDP target in which they try to boost the overall growth of economic activity by actually having a target for nominal GDP. Because if you do that, it's the fastest way of trying to guarantee that debt to nominal GDP starts to come down. And in some ways, the Federal Reserve Board in the United States has de facto almost gone to that already. And I wouldn't be surprised if that is something that other countries do in a more formal way.
Right, Jim, the reason I asked you that was because we all are observing the way Ant Financial and the authorities there are talking with each other and the commentary coming out there. But we've got last 3-4 minutes. So I would like,
yes.
you have coined the word BRICS way ahead of everybody else. Even India was not taking a serious emerging market then. Mm-hmm. What's the next economic miracle in terms of countries which you are eyeing right now?
So I'll give you two answers. You know, to be honest, I think the answer to that is China and India. I just published something about the BRIC journey because this year, November this year will be the 20th anniversary of when I thought of the idea, and I published something via Project Syndicate. I had a brief conversation afterwards with some well-known commentators. And of course, people always lament the fact that both Brazil and particularly Russia have been in the last decade so disappointing. But when I look at the decade ahead, the two most important countries that are going to influence the world growth rate are China and India. And so in that sense, they remain the miracles. And because they're so important, therefore the BRICS story remains dominant. The second part of answering you, if I think outside of that, I would give you the following candidates, and some of them are the occasionally discussed, and as your colleague introduced me to, is about the next 11. I think Indonesia is particularly intriguing because it has very favorable demographics also. And very interestingly, it's come through the past decade so much better than most people would have dreamt of. I think Vietnam is very interesting as a sort of smaller version of China, particularly as China becomes more expensive and doesn't want to export so much. And then the big one, which is the perennial, if not annual, certainly perhaps decade challenge, is Africa. And one of these decades, Nigeria, which has, along with India, the best demographics in the world, is going to sort itself out. One of these decades, I'm not sure if it's this. I'm not sure if it's this one, but when it does, Nigeria is going to be a big place.
Right, Jim. Wonderful chatting with you. I wish we had more time, always wonderful to have your thoughts. Well, Indonesia and Vietnam clearly are on my travel bucket list when all these restrictions open. But on this wonderful note, I'll thank it over to my colleague Purvi to take it away. Thanks so much for your time, Jim. Wonderful.
Thank you very much for having me. I've enjoyed it.
Thank you, Jim, and thank you for your time and those solid insights. It's always a pleasure to listen to you and your provocative thoughts. And thank you, Ajay, so much for doing this. So as you digest Jim's loaded speech and ideas, here's something to munch. When you trade and invest, what are the tools that you need the most? Are those trading tips? Well, I can understand that, but what else? News and information, data, or is it much more than that? At etmarkets.com, our product people are always at work to make things handy for you. I invite Puneet Kukreja, the product head of ET Digital, to give some glimpses on how a modern markets app is tweaking technology to power your trade. Listen in, these 10 minutes might give you something that you may not be aware of. Hi, Puneet.
Hey, can you hear me, Purvi?
Yeah, hi.
Hi. So, hello everyone. I hope I'm audible.
Yeah.
Yeah, okay. So, first of all, I would like to thank Jim for sharing such great insights. I loved the concept about passive plus investing, my personal favorite, and learned a lot from Jim. It was indeed an incredible session. And I would like to present my screen. Most of our audience today belongs to investor community. And in next 10 minutes, we'll give a walkthrough in terms of some splendid products which Team ET Economic Times has developed in last 8 to 10 years to make investors really, really successful with their investment decisions. Let me share my screen. I have prepared a small deck around it. Just a minute. All right, so most of millions of our investors are actually benefiting from the kind of insights, editorial stuff which the Team Economic Time does. And the idea of this session is to aggregate everything into one place so that everyone gets a clear view on how to unlock the true potential of ET markets, where the team is working really hard and ensuring that investors get maximum buck for their money. So our core mission, why do we even exist, is again, I'll reiterate that we want to make our investors really, really successful. And the word which is here is by sharing trustworthy stock market insights. When we say trust, we as a team highly over-index on trust and don't make any compromises. If need be, we make additional layers of quality checks before we put out the information. So stock markets is such an area where it is flooded with a lot of information and noise. The key target for us is to clearly filter out signal from the noise for our dear investors. Audience may be able to relate that even best of the legends, not even in investment industry, but also in sports, need regular guidance and training. So we believe that with the platform which we have developed, a technology platform which is helping our editors, creating some tools with the help of AI and ML to help our investors, that we will be able to make our investors really legends in their own field and they can get best out of the stock market. Coming specific to stock markets, there are 5 core things which we find to be common among most successful investors in the world. And these are actually starting from visualizing the top level macro trends, going deeper into industries, evaluating the companies. And last 2 are very important, that investors need to be aware about their own limitations around resources and time which they can spend. And then lastly, control on emotions. If you see, a successful investor is made by multiplying all these 5 traits. It's not additive, it's actually multiplication. If any one of these goes wrong, so there will be huge problems with the investment. We can help with our tools and insights on first 4 parts of it, which is helping investors getting a 30,000 feet view about macro trends and sectors, and at the same time helping them drill down deeper into the details to evaluate specific about companies. Now, let me come to very, very specific things which we do at ETMarkets. So ETMarkets, the core objective is how can we provide right insights, right information at the right time, because this is extremely important. So when most of us are sleeping in the morning, our team starts the day at 4:30 in the morning, where they start monitoring what happened in the global market. And when people get up, the letter goes from the desk of editor every morning. I'll say every morning, where we take close to 2 hours understanding what happened globally when people are sleeping, and when investors get up, they get a ready-made curated letters from our editor's desk along with the morning podcast. If you are driving to your workplace, you can just listen to a 5-minute podcast to get a brief glimpse of what happened when you were sleeping. And the team stays with the investors throughout the day till the time you sleep. So there is a live blog running. So there are different widgets around stocks in focus during the day, which investors or traders need to be very, very conscious about during the day. We also understand that most of the investors spend inordinate amount of time during weekends to evaluate a lot of things, and in fact to catch up stuff which they were not able to get time during the weekdays. So for that, there are products like weekend podcasts and insights. I'll share some screenshots and some glimpses of those products. And if you have not subscribed to these newsletters and podcasts, I would strongly recommend. Millions of investors are uh, actually making full use of all these tools and initiatives. Similarly, there are a set of investors who are very, very sharp, very focused, very particular, and they want very specific updates about sectors and industries. For that, again, there are tools available to follow companies and sectors, in which if anything happens in that sector, industry, or particular stock, you will immediately get notified on your mobile apps and emails. So again, it's like a Swiss knife. So we have understood different use cases of different set of investors and built tools around it to ensure that whatever suits your need, you should be able to unlock the true potential of ETMarkets by using those tools. Let me share some screenshots with you. So on the left, you can see the letter which goes from editor every morning to our investors before the stock market opens up. And then there is a live blog which runs throughout the day. And then you can see clusters of news, morning brief, evening brief, news, noon brief, to keep investors abreast of what's happening during the day. Similarly, it's not only about the day, it's also about special events like earnings, IPOs, where we do detailed analysis and create an unbiased perspective on earnings analysis as well as IPOs. And Indian IPO season, as you all know, is really hot these days. This is our personal favorite, where we have seen a lot of people building habits. So they have been frequently visiting our newly launched stock pages. And if you see, these are really comprehensive. In India, you will see most of this stuff behind paywall, or you have to pay for it. But at ETMarkets, we believe in commoditization of this information, where we get a lot of insights from our experts and analysis from industry leaders, as well as from our editorial team. And with the help of technology, we also help in easy visualization of data to ensure that investors don't spend time in collating information. They should be spending time thinking and evaluating, rather than spending time in just collating information. So whether it is about visual appeal or the depth of information, we have got it all covered in our stock pages, which have been recently launched, and we have been getting rave reviews about it. Similar to this, we also realized one core need of investors, where they know where to invest. They have broad level filters in their mind. There are more than 4,000 stocks listed on the stock exchange. They find it difficult to find relevant stocks basis their need. Again, these are kind of tools which are usually paid in the market. We have opened up everything for our dear investors, where you can come and shortlist stocks which match your investment criteria. So there are some predefined screeners where you don't need to do anything, just kind of go with the recommendations of our experts, or you can customize it to the nth level with more than 20 different attributes around stock to figure out what suits your need. So it's not only fundamentals, we also have built some screeners based on technicals and also for long-term investors, mutual funds. So screeners cover stocks from both fundamental and technical perspective, as well as mutual funds for long-term investors. And testimony to all this, what I said is actually coming with very positive reviews from our readers. And also the mobile apps which we have, both iOS and Android, are more than 4.6, 4.7 rated apps, which are best in Indian news category by far. So from that perspective, we believe if you're not using ETMarkets tools and information to the fullest, we urge you to just give it a try. And we are really confident, considering we have seen a lot of case studies from millions of investors who are taking benefit out of it. You should also get a lot of benefits by using these kinds of tools and insights. Having said all this, I believe we are still far away from where we want to be. We want to still deliver a much better experience. We are still better than probably our competition, but we still have a long road in terms of providing better reading experience, better visualization experience, and more importantly, better coverage across some long tail of stock market and international sectors. We are expanding our team, and in the months to come, you will see a lot of action happening in ETMarkets. And believe you me, we are going to be the best stock market analysis platform in the country. We already are. We are going to grow by leaps and bounds. We believe that our investors are the best source to make us better. So here I invite all of you, whosoever has any ideas, please join our user panel. We take our user feedback very, very seriously. In case you have any suggestions for us, please write to us at research@economictimes.com, and we'll be happy to have one-on-one interview or focus group discussion with you to understand your pain points better and help our millions of investors who are there on our platform. Thank you very much. Over to you, Purvi.
Thank you so much, Puneet. So after the delightful presentation, we have an important panel discussion. Passive investing is catching up fast with Indian investors. And in this session, we would be checking out the pros and cons of active and passive investing. We have with us Ashish Somaiya, the latest mutual fund executive to jump ship and get into alternative investment as the CEO of White Oak Capital Management. Ben Johnson, the Director of Global ETF and Passive Strategies Research for Morningstar, is joining us from Chicago to bring in the global perspective on passive investing. We have Kalpin Parekh, the President of DSP Mutual Funds from the active investing side. We also have Cole Ghosh, the South Asia Head for S&P Dow Jones Indices and CEO of Asia Index Private Limited, who is here from the index investing side, and which is another voice for passive investing. And to chair the session, we have one of the torchbearers of the golden age of India's mutual fund industry, Madhu Kela. He now runs a proprietary investment vehicle, MK Ventures. Hi, Madhu, over to you.
Hi, good afternoon.
Hi.
Hello.
Over to you, Madhu.
Yeah, hello. Hello, good afternoon, everyone. What a delight it is to be with all of you. And I warmly welcome each one of you to this session. I have switched my role. I'm always on the panel, but it's a privilege to moderate this session. And over the next 1 hour, hopefully we'll get a much deeper insight on active versus passive investing. So, Ashish, straight coming to you first, because you are the most familiar of the faces. Just if I can have some opening remarks from you about, what your thoughts are on active versus passive investing. What have you experienced in your career? What the trends which you are seeing? And so if you can just start up and kick off the session.
Sure. So, I'll share. Thank you very much, Madhu. It's a pleasure to interact with you on this panel. So 2 or 3 thoughts that I can share. I think There is a lot of debate, and generally speaking, what I've seen is that there is a lot of polarization, like we see in every nowadays, whether it is politics or the stock market, everywhere there is a lot of discussion about polarization. And even with respect to active versus passive, I see a lot of very hard positions and very binary positions being taken by industry experts as well as participants. I am clearly not in that camp. I personally believe that there is a scope for coexistence. And I'll tell you a few reasons for this. What I've seen is that the moment the discussion about passive comes in, everybody straight away jumps into alpha and beta and the lack of alpha. And, a lot of data starts getting thrown around to basically prove this way or the other that there is alpha or there is no alpha. And people start slicing and dicing different market caps and different time horizons, and data starts flying all across. I personally think that before jumping into alpha beta kind of serious hard discussions, according to me, one of the big reasons for passive to come up is actually got to do not with, at least in India, it's not got to do with the absence of alpha really. In fact, I think it is because of simplicity and convenience. Because if I see specific to India, I have always said that there are 300-400 companies which are worth buying. And to buy those 300-400 companies, we have some 2,000-3,000 equity funds. And our industry makes life very, very difficult for a mutual fund investor to pick funds. And I find a lot of investors have 20-30 different schemes in their portfolios. So eventually they are buying the market. And I think sometimes passive funds play a great role. Nowadays there are a lot of investors who are digital first and they are DIY. So if you're just entering the industry, if you don't know what to buy, the least you can do is buy the market. Very easy to do it, especially if you are a fintech participant. So my sense is that the scope for passive is actually because of simplicity and ease of execution, very good for novices and first timers. On the other hand, if we really want to talk about alpha, I just put it in one sentence that if you look at India as a market, I think we should not worry about index capturing the market before the market has even captured the economy itself. A couple of years back, we didn't even have any insurance companies listed. We didn't have any AMC listed. The first insurance company has come in the index, I think only a few weeks or few months back. So very, very long journey. I don't think the index in any manner captures the market because the market itself is not capturing the economy as of yet. So I think very early to take hard positions, but I can see the coexistence purely because of simplicity.
Great. Thank you. Welcome, Ben. We have grown hearing the name of Morningstar. They were real stars. This company was a real star in my early stage of my career. And it's a pleasure having you here on the panel. Thank you so much for joining today. Ben, if we can have some opening remarks from you on active versus passive investing and what your experience has been.
Madhu, thank you for including me in the conversation. And what I would say is I would really echo many of Ashish's opening comments. First and foremost, as it pertains to what is often framed as a very binary discussion, active versus passive, in the polarization that ensues. What I would say is that oftentimes that's a false premise, that this is a very digital discussion that we should be having, that fundamentally all investors are active investors, and active exists on a continuum of degrees of activity. So there are investors that lean more towards passive. They may own index funds and tend not to look at their portfolios that often, not tinker with them that often, to rebalance every so often across different asset classes, different regions. And there are other investors that are very deeply involved, that are keen investors that might get down to the level of individual security selection. So I think first and foremost, we need to reframe this debate as not being binary, but being a digital debate, and recognizing that at the end of the day, we're all active investors. And I think the key elements of sort of simplicity and ease of access that are offered by index funds have been key elements of appeal to investors around the globe when it comes to just simply getting market beta. Because market beta at the end of the day is what does most of the heavy lifting for investors in moving their portfolios in the direction they want it to move, which is upwards and to the right over time. Everything else for an investor, really, at the end of the day, is gravy. It's that aspirational alpha that might actually be real and material, or might be real and materially negative, depending on how savvy an investor you are, or how savvy those investors that you've hired through actively managed funds to invest on your behalf. So there's a lot to discuss here, obviously, and I'm looking forward to digging in with everyone.
Okay. Fantastic. Kalpen, coming to you, welcome on the show. I really appreciate you joining us today. Kalpen, this discussion is not moving towards a debate. I hope you will take a position in favor of active investing. Otherwise, I will have to change places.
I think, Madhu, when you were there in the industry, such debates never happened, right? Because the alpha was so large. We had, so a couple of days back, we were talking to a global client who wanted to evaluate India. And we were showing him the journey of last 2 decades of one of our oldest fund, which has a 24-year history. The alpha over 24 years is around 6%, but the alpha in the first year was 9%. So the obvious question from him was that the alpha in the second decade has started coming down. And since you provoked me to, have a different stance, I definitely feel passive will emerge fairly fast as we progress ahead. As we speak today, around 40 lakh folios have opened up in the passive space. So far, the passive space has largely been dominated by the EPFO money, but individuals are also now recognizing that before we aim to beat the market, we should first meet the market. In the attempt to beat the market, we end up not even meeting the market more often. And there are very obvious data points and reasons for that. So I think the space will emerge large. On days when I am in a mood of, some ego, I feel that we definitely will beat benchmarks. Why can't we beat benchmarks? Because if you take out the weak companies of the benchmark repeatedly over time, then alpha is assured to us. And, I would take my alpha as my birthright. And there are days when the market will humble you, where you realize, I wish I had some exposure to Nifty and Nifty Next. And I'll just give you some data points, because this is an audience with data points. And data really helps you in bringing down a lot of these illusions and ego. Data tells me that if we just do a combination of Nifty and Nifty Next, and these are the 2 most scalable indices, forget everything else. Baki sab mein, it's very difficult to build an index portfolio. Just a combination of 50-50 of these 2 portfolios would have taken the investor into the top decile of active funds in the large cap and the multi-cap universe. So if you want to be an investor in the top decile, one part of your portfolio with this combination over the last 16 years, I have data for the last 16 years right now, and it won't look too different if we take it for last 5 and 10 years. So I think it will become a very critical part of the core. Having said that, I also feel there will be few managers who will deserve alpha, who will create alpha, but there will be very few. There will be that, it won't be a standard bell curve. There will be a power law that very few managers will be able to generate alpha wherever they're able to have a temperament, discipline, and skill sets. And I think it's going to be a very challenging phase for all of us in the industry. We will have to earn our alpha. We'll have to earn, the right to say that the past 2 decades of alpha of India can be extrapolated in the future. I come from a camp of not taking it for granted. I come from a camp of being paranoid about it, that alpha is fleeting. We have to work hard. We have to, constantly keep strengthening our approach of fundamentally altering our temperament to deserve alpha, which means a certain orientation of long-term, an orientation of sometimes being contrarian, sometimes accepting how the market is. So that's my take. I start by saying passive will grow. I also start by adding that in my personal portfolio, I don't try to have the or word. I always have the and word. And just to add proof to it, as of now, 7% of my equity portfolio is in passive funds. As trend progresses, I will, take a call. What should I do? And last point, whenever in a calendar year, active funds, my portfolio does very well. In that year, I invest in a passive fund. And likewise, at the end of a year, when Nifty has done very well versus some of my active funds, I would allocate more to an active fund. So you keep playing the, reversion to mean that keeps happening. As a framework that I have felt appropriate for my investing. I just wanted to give proof of concept so that my theoretical words have some outcome. Thank you.
Well, thank you so much. So you're actually trying to be active in a passive manner. So, Koel, just coming to you. Did I spell it rightly?
Yes, that's right.
Yeah. Welcome to the show. Really appreciate you joining us today. So, if you can just have some opening remark from you as well on the subject of active versus passive before we get into a real debate.
Yeah, thanks, Madhu. Well, of course, I would say my historically, I used to work with the active space. I was with a part of ILFS Mutual Fund, which I don't know whether anybody knew that time ILFS Mutual Fund existed. I was with UTI Mutual Fund, and then I came into this passive zone where I was taking care of the index business. Now, obviously, index is the fundamental baseline of creating passive products. So when I started my journey in trying to propagate passive in India, I walked into very familiar fund managers and asked them, how would you like to, kind of create an index fund? And they said, do you want to take my job? That was the kind of reaction I got. But today, those same guys are saying, okay, what is the kind of idea I can get for a passive product? Today, if you see, India has around 99 products. We have we are nearing $40 billion in assets under management in the ETF space. This is actually a 10-year growth of nearly 40%. And if you look at it globally, of course, the numbers are much larger. The global passive space is almost at around 8 trillion, but the 10-year CAGR has been around 18%. So definitely India is galloping at a much more faster rate at passive. And I think even if people want to, deny that, this is not a trend, which is not actually the case, it is. And the surprising part is that last year has seen a surprising uptrend in the acceptance of passive and the interest of passive, not only in creating local products, but also creating an option for international indices. I mean, as India, you're aware that we have a tremendous home bias. But we are seeing that shift happen as well. And, as, Ashish kind of spelled it out, it's simplicity, for a lot of, our markets where people need more financial awareness, that this is a space which one can easily jump onto because an index, based investing, it's transparent. You have all the information there. It's rules based. And I think it's very just easy for you to access, like, they said market beta. And it's a very, very simplistic understanding for people, even from the mutual fund industry. It's come a long way. But today, if one has to look at the mutual fund industry, you see this long stream of schemes and you get completely confused as to how do I filter through? Unless today I have that background and I understand there are so many schemes and I sometimes get overwhelmed. But yeah, it's easy. Even the last 1 year, we did a small little research where we said, okay, if I invested in the Sensex and say the S&P 500 as a combined portfolio, not weighting it equally, but in a rebalanced format, the combined portfolio was actually giving higher returns than individually each of these indices, and also a lower volatility. So I think passive is something that is coming to the forefront for Indian investors. And I think the more knowledge and awareness that one can create about it, it's more, it's better. And I agree, it's not an active versus passive. It is active and passive. So I always propagate core satellite. So it depends on who has a bigger conviction on passive can go as core passive. And if you have a higher conviction as active, you can go core active. So, this is, I think, a debate. No longer, I don't think so we can call it a debate. I think it's how we adapt both the processes, both the options rather, to include it into your portfolio as a part of your portfolio strategy.
Thank you so much. Let me also, add something, because all my life I've lived only active investing. Maybe the trend is changing now. Maybe people are becoming more adaptable to passive investing. I can't fathom, if there was no active investing, what will be left in the market for people like us, essentially. So, we grew when I joined Reliance Mutual Fund. The Reliance Growth Fund NAV was 11 rupees, and it went to 1,200 rupees when till the time I was actively involved in the fund. So it was like 110 times in matter of 15 years or so. And the CAGR post fees, and I would say post tax, because at that time there was no real long-term capital gains tax. So the CAGR was 24-25%. So obviously we have lived through it, and the proof of the pudding is in the eating. So let me come to you, Ashish. You've been you've grown the Motilal Oswal Asset Management Company, and you've done a tremendous job out there. And obviously, they have also believed very much on the active investing. So, how has been your experience of active investing, and what are the, if at all, are we saying here that over a period of time, the opportunity to create alpha is reducing, and that is why more passive investing is emerging?
No, so actually, my thought process is that, I always divide the whole equity, so managed products in the equity space. I would divide it into 4 strata. So I would urge all of us to kind of imagine that there is a pyramid, and the pyramid has 1, 2, 3, 4, 4 levels. At the base, I would put the beta. Then I would put actually, what a lot of bulge bracket mutual funds that we have, which have, risk tolerance limits. So they typically pretty much have index representation, but then they have underweights and overweights. So there is beta, and then there is beta plus. And then since you quoted my previous employer, I worked very long in Motilal Oswal. I would say that their equity funds, for instance, if you just take that as an example, they are in the bracket which is called index agnostic. So, there is a bottom up philosophy, and the portfolio gets cast basis certain thought process. And they don't really worry where the index really is. And they believe that if they have the right stocks, then over a period of time, they'll end up beating the index and creating wealth. So there is the beta, then there is beta plus minus kind of strategies. Then there are index agnostic strategies. And the top strata is actually the alternates, right? Alternates meaning, there is long short and there is absolute return, and there are, they are way away, nothing to do with the index, really speaking. So I have always imagined from an investor's perspective, if you see simplicity, it goes from, the bottom is the simplest. So if you see simplicity, if you see risk return, in every way, I have always seen the equity space as a continuum of these 3 or 4 strata, which I actually described. And like I said in the beginning, I am nowhere in the camp which believes that in India, there is I don't think that there is lack of scope in generating alpha. Because, like I said in my earlier comments, see, as a professional CEO who is in the profession of serving requirements of investors, if I keep this whole continuum of the stratas and the pyramid in mind, then I'll be able to serve my investors better. That's how I would look at it. And that's how we actually work. Because if you realize Motilal Oswal is in alternates, it is in the index agnostic strategies. And in my later part, with help of colleagues like Koel, we did create like S&P 500 as a passive product. We created NASDAQ 100 as a passive product. We created India's first broad market S&P 500 as a passive product. We actually created the first small cap 250 basket. So there are many things we did just to ensure that investors have choices on the entire continuum of simplicity and risk return, as I mentioned. But again, to reiterate, I never did that thinking that there will be no alpha. I'm quite sure that there is alpha, there is a lot of scope. And as I said in my beginning comments, if the market doesn't cover the Haji, sorry.
Just to come, because this is a show for investors, and a lot of retail investors and HI investors are watching us. So if you have to advise someone today, like Haji, if you have 100 rupees to be allocated, what will your stand be? How will you put, and where will you put the money at 15,000 Nifty?
At Kalpen's, I'll take Kalpen's example, and I will reiterate that I voted, or I mentioned something about passive purely in the simplicity and risk return continuum. But taking Kalpen's cue, if you ask me, my personal money, every single rupee is in active management.
Sure.
Absolutely only in active management, and I've always invested in the company where I work, so that doesn't change.
Okay, so basically, and what is your advice? Because now, of course, you are going to set up a mutual fund here. So, but for a layman investor who's wanting to invest money in equities, what your advice will be? How much will you allocate to passive and how much will you allocate to active investing?
I think it depends on the investor's awareness and knowledge. Is he advised? He or she, is that person seeking advice? Do they know how to pick the right manager? Do they know how to do the asset allocation, etc.? So you know what goes with advising and wealth management.
Of course, yeah.
Yes. If it's a novice who has
assume he's advised. Assume that he's advised because there are no dearth of advisors today.
So then I think the advisor should help that investor to pick the right managers in the right segments. Why I mentioned about novice is because if you have no clue, then you just buy the BSE 500. That's the. If you don't know what to buy, you buy the market, but you better be in equity. That's how I would put it.
Fair enough. Okay. Ben, just coming to you, can you share us, a little bit about the international perspective of where this industry is growing? Because we have seen humongous amount of cash outflow from the US markets in the last 3-4 years from the mutual funds and money going more into ETFs. So what is the kind of trend which instigated this kind of flow? And what do you see over the next 3-4 years in terms of the shape of the industry, active versus passive flows from the retail and HNI investors?
Yeah, so it's a great question. I think what oftentimes gets framed as a shift from active to passive is really more fundamentally a shift from high cost means of accessing the market in different strategies to relatively low cost means of accessing the market in different strategies. If there's one durable edge that an index strategy has over an active manager, it's the extent to which they take a markedly lower fee, in some cases a fee that's a fraction of the average fee that's charged by an actively managed fund. And that's a durable edge. And fees have come into ever sharper focus in a lot of major markets, in the US, in the UK, and continental Europe, where we've seen regulatory shifts, regulatory imperatives, moving advisors away from fee-based models of doing business, or away from transaction-led models of doing business towards fee-based advice. So as fee-based advice has become sort of the predominant economic regime in many markets, advisors are sharpening their pencils and they're looking at ways to squeeze the fees of the asset management products that they're investing in on behalf of their clients. So that is registered in many instances as a shift from active to passive, but I would argue that from an economic point of view, from kind of an advice imperative point of view, it's really kind of a stronger emphasis on fees that we're seeing as we've seen this model shift. So that's important to note. The other important shift is a shift in the investment wrapper of choice. So increasingly what you're seeing is that the asset management industry is replatforming really away from mutual funds, which have been the investment vehicle of choice for many investors around the world now for decades, to other formats. And ETFs have been a primary beneficiary of this shift because they're a more efficient vehicle for investors. They tend to be less costly. They tend to, in many regimes, be more tax efficient, and they're more readily available to smaller investors at smaller investment minimums. So a small investor in many major markets today can actually download an app onto their mobile device and allocate a tiny amount of money to a diversified basket of ETFs, owning fractional shares of each that give them access to nearly every tradable security on the planet. And all of this has really been driven by massive advances in technology. So investors around the world have a ton to celebrate these days, because at the end of the day, what really is going to move the needle for an investor, for a client, is whether they're in the market or whether they're out of it. Everything else, again, is gravy, whether it be alpha derived through security selection or manager selection. What matters most over the long term is whether or not investors have exposure to market beta, which, to my earlier point, over a very long horizon is going to do most of the lifting in investors' portfolios.
But Ben, just being a devil's advocate, because in a market like this, when you have seen 100% return in indexes in the 9 months time frame, and most international indexes are up like 50-60%, and is fee the real criteria to invest money? Whether if you're going to save 0.25 or 0.5%, should that be the criteria for you to make investment?
I think that becomes a more important point when you frame it in terms of the spread of options that you have at your disposal, right? So all funds, be they active, be they passive, or be they somewhere in between on that continuum, are going to have varying degrees of exposure to that market beta. So what we see is that over a long period of time, if there's been any predictor of future performance relative to benchmark that investors can rely on an ex-ante basis to understand which managers are more likely to succeed, it's fees. And we've documented this in a variety of regions around the globe in one of our flagship reports, which is the Morningstar Active Passive Barometer, which looks at the performance of actively managed funds relative to index funds and indexed ETFs. And what we see is that lower fee active funds tend to have greater than average odds of succeeding for investors over the long term. And part of that, honestly, is just dictated by the fact that they're also more likely to live from the beginning of the period to end. So we've talked about how this funds menu in every major region, India included, is absolutely massive. And of the thousands of funds you see today, the likelihood is that maybe half of them will be around 10 years from now. And the reason that most funds close isn't due to issues around commercial viability. It boils down to issues of performance. Funds close because they fail to deliver to investors something better than what they would get from investing in a broad-based index fund.
Well, if I can just throw the same question to you, what have you observed in your career? Is fee really a very, very important aspect for the investor to decide that, whether you are paying 0.25% or 0.5%? Understandably, I can see that over a longer period of time, it may make a difference. But supposing if you chose a lousy ETF or a lousy index to follow versus a very active manager, does fee really make a big difference for an investor in choosing a fund or a vehicle?
This question is to whom? To me?
This is for Koel.
Oh.
That's what I was also not sure whether you said Kalpit or Koel.
No,
yeah. So I think today, if I have to look at India as a scenario, investors are still understanding and comprehending the difference between passive and active. If you are aware, sometime back, SEBI just reorganized the entire categorization of schemes as to large cap, small cap, mid cap. That made a lot of difference in terms of apples to apples comparison, and that had given a huge, I think, clarificatory view as to how mutual funds could be compared. And I think that gave some level of clarity to others. Now, I'll come to the expense ratio part of it. One aspect is that we have a report called SPIVA, which is called Standard & Poor's Index versus Active. Definitely, we are seeing in the large cap segment, it's basically a scorecard which compares how active fund managers are performing vis-a-vis the index. Now, in the active space, it's definitely seen in the long term, 3 years and 5 years, almost 80 to 80% and above fund managers are actually underperforming the benchmark. In this case, of course, if we had chosen the BSE 100. But, coming to, your concern about whether, active is a space that is going out of, fashion, you see that in the mid-cap space and the small-cap space, you have the active fund managers actually doing a better job. Now, that is happening because large caps are far more market efficiency in the large cap space. So as more and more market efficiency comes into the market, you'll find those areas streamlining and active fund managers finding it hard to beat that. But in other cases, you will find active still having that edge. Now, on the expense, definitely, it is globally as people are, seeing the difference in, the markets are far more efficient. So active fund managers, again, there are struggling to beat the markets. So that's where, every little basis points start making a difference. And that's where even the passive fund managers are trying to make that difference. Now, Ben mentioned about market beta, but you would be aware that there is a set of indices we call smart beta, which is nothing but we take a lot of criteria that active fund managers take, stuff like book. I think I jumped out.
Yeah,
Can you hear me now?
You can carry on. We didn't miss much.
Yeah. Okay. So I think there is a smart beta, a space where we take the same criteria that an active fund manager would use, convert them into rules, and thereby, the index is ideally giving a differential return, which may have a slightly uptick compared to market returns. Now, that is another space that is really, really growing out, and investors are actually evaluating that space. Of course, there is again ESG and sustainability, which is a whole new conversation. So there are a lot of scope within the passive space where one can, explore. But again, Madhu, coming to your concern on active, I think India has that ability and areas where active has scope. And thereby, for investors who have, again, as Ashish said, investors who have the necessary acumen, they have the necessary vigilance to look at the market, scope it out. Yes, all out, go and, get out there and, evaluate the active market and get there. But I think today a large part of Indian markets are, and the investors there are still looking for advice. There are a group of now registered investment advisors who are coming out, who are also keeping a passive portfolio as a part of their asset allocation. So the way I see today is, as this passive wave starts progressing, you will see people allocated basis on how they are convicted. Like Kalpen said, I put every money in active because he today has been there in the market for so long. He understands stocks. He understands how they move. He has a generic understanding. He has fund managers who are also giving him so much of wealth of information. For an investor on the ground, sometimes that much information is too overwhelming. He doesn't know how to filter it out. So then such investors find it much more easier because you have an independent index provider. So like somebody like S&P Dow Jones will create an index with having no intention as to how the product will be, because the product is created by somebody like Ashish or Kalpen. They are creating the products. We just ensure that we create an index that reflects either a market or a strategy or a theme. Now that is something, but again, like I said, an index, there is a fixed rule. So I can't jump in and jump out as and when I want. There are fixed rebalancing schedules. So it will give a set pattern of returns, which then is maybe something which a novice or somebody who's learning and getting into the market finds it easier to slowly foray into the equity markets. But it helps him, experience the equity markets or even the fixed income or commodities, because passive is running across all these asset classes. So I think that is the experience that a passive investor is getting. But that said, again, like I said, my core theme here is core satellite. So the person who, if you are convinced that you are really good at active investment, go out there and put it. But there's always a good opportunity to keep 10% as a buffer and keep it in that satellite strategy, because it just ensures that there is that steady flow of return that is coming into your portfolio, come what may.
Kalpen, of course, you come from one of the most respected asset management companies. What is the kind of changes which you have seen in the investor psyche in the last 2-3 years? And in your experience, apart from cost, why are people choosing passive investing versus active investing?
Data still shows that the choice of passive is more institutional in nature. So in a 2 lakh crore AUM, See, equity AUM is around 13 lakh crores. 2 lakh crores belongs to passive funds. Almost 1.7, 1.8 lakhs is institutional, the EPFO money. The retail investors' money is still not moving towards passive, because passive, first of all, is almost zero cost. See, in India, in fact, passive funds are run at almost 5, 6. Although free, people are running it free of cost right now. So there is no incentive also for you to really take it to the market. So by default, then, those investors who are extremely cost conscious will automatically find passive as their first port of call. So the trend that we are seeing is young money, digital money, and people who want simplicity, who don't want to get into fund selection efforts, are choosing passive as their first choice. Number two, people are also noticing that in the last 5 and 10 years, if most of the known equity funds have not beaten benchmark.
Exactly.
The consumer is also very wise today. Today, the whole world is getting disintermediated. So people are reading about the big trend that I'm seeing is, on one hand, people are making effort towards understanding their investments and not just blindly putting money. So we can't say that if it is retail, it is dumb money. Even retail investors are getting relatively smarter, and because of technology today, they are able to listen to various points of views, which was in the old days not easily possible. Today, at the click of a button, they can read the best of research globally and hear the best of experts. I think the audience is becoming more discerning, more aware in the existing breed. Then there are, of course, new investors also who are coming in, getting carried away with the last 3 months, 6, 9 month returns. I have seen many of my friends in the yoga class saying that in the last 9 months, my investments have gone up by 80%, whereas your mutual funds have grown only 14% in the last 10 years. So that's again a very naive comparison, that you're comparing your direct investment in the last 6 months versus a mutual fund over the last 10 years. So there is a melting pot of investors which makes the market, which will make it challenging, at the same time create opportunities. But clearly, investors who are younger in nature are preferring more of passive funds. Investors who are more digital in nature are preferring passive funds. And also the cost conscious investor today also has the direct plan to some extent, which has neutralized the cost benefit. We have designed funds, for example, where we went with a very simple rule that, and then again, I'm just trying to go at a very fundamental level beyond this debate of active and passive. What is good investing all about? Either you buy good businesses or good prices, one of the two, and ideally both. Can I create an index which tries to do both and eliminate permanently bad businesses? So we just did that simple exercise. That exercise generated 4% alpha over the last 16 years. Just keep eliminating bad businesses. And then you say, I'll offer it at half the cost of active fund, slightly more than passive, but half of active funds. It has enough value for the manufacturer, for the advisor, as well as for the investor. So another trend that I'm seeing is design of rules-based funds, which code for sensible structure. The idea is what matters in long-term wealth creation. Good companies don't overpay in terms of valuation. So even for a good company, if you pay 200 times, eventually you'll not make money. Or at times average company, but at very good price. Can an index code for some of these rules today? The answer is yes. Can I design it at moderate cost because we are using technology to design a fund like this? And the answer is yes. So these are the type of trends which are emerging, and we do see investors seeking ideas like this. So I think it's going to be a very exciting time. We will be on our toes, and investors will be, why choices confuse them, but choices can also empower them, because our competition will make it easy for them to pick and choose the best products at the right price. So maybe what happened in the telecom industry with pricing benefit to our investors, so that's likely to play out.
Ben, one thing which I observe internationally is essentially because of the $100 ETF of Amazon and Apple, you have basically narrowing of stocks. And some of these companies, because of the tremendous amount of inflow which is coming from retail investors, that I can buy an ETF of Amazon, Apple, and Facebook for $100 or $200, tremendous amount of money is coming into this into these companies, which of course is making the valuation a challenge, right? Because at the end of the day, at a zero interest cost scenario, some of these companies are starting to trade at 25 and 30 P multiple of current year and next year earning. So what is your view? Is the money actually driving the valuation of these companies? And
Yeah, it's a great question and one that gets asked quite a bit, especially where we are right now in this moment in the markets where valuations stand, and in the fact that really around the world we've seen increasingly concentrated leadership amongst a small handful of names across most major markets, which I would argue is just fundamentally a law of nature. Power laws rule everything around us, and what has been market leadership has also been a real opportunity cost for many actively managed strategies that either have omitted some of those market leaders from their portfolios or have otherwise been underweight the Apples and the Amazons and the Teslas of the world. Over a long period of time, what you're signing up for when you're signing up for a broad market index exposure is kind of offloading all of the decision making, all of the price setting, all of the research onto all other market participants. You're relying on the wisdom of the markets, but what the little asterisk, the disclaimer should say is that you're also going to participate in all of the various follies of the markets over time, which are moments in time like we saw with the TMT bubble, for example. Now, that may feel like a less than ideal strategy in those moments, but what we've seen is that over a much longer time frame, one that sort of matches most investors' time frames, that's delivered better outcomes than most actively managed strategies. So if you're going to rely on the wisdom of crowds, you have to realize that the crowds aren't always going to be wise per se, and that this is really no different than what you would expect from a successful active manager. That if you look across the full spectrum of successful active managers over time, there are distinct periods of time, there are distinct moments in the market, episodes, where they derive most of their value. It's not as though alpha generation is a very steady and consistent process for successful active strategies. It comes in markets where, by virtue of either having superior information, processing that information more efficiently than your competitors, or simply just relying on what is the last, I would say, advantage, the last potential source of alpha for investors, which is just having a longer time horizon than the market at large. You realize those gains.
No, Ben, sorry to interrupt. My question was, are the markets narrowing because of the flow of the fund into by the select ETFs going into these select companies? And is the valuation really becoming expensive because people are just thinking that I'm buying a cheap investment product when I'm paying a lesser fee, but it is getting more than compensated at the valuation front?
No, absolutely not is what I would say. Investors, market participants at the margin are the ones that are setting prices. And this is a question that's come up, time and time again. If you go back as far as the mid-1960s in the US, professional investors were having the same concerns, asking the same questions about retail mutual fund investors, because mutual funds were first becoming popularized amongst smaller investors in the US. And the pros were worried about what was referred to as the quote mutual fund situation, whereby all of these new investors in mutual funds were somehow distorting markets and pushing prices. The only thing that's changed is really how we're investing. At the end of the day, the markets and price setting is a factor of where at the margin market participants think fair prices are. And at the end of the day, indexes themselves and index portfolios, index funds are price takers. They're going to take whatever the market is going to give them. They're not looking to try to embed any informational content, any sort of edge into the market. So even just sort of where rubber meets road, most broad-based index funds are executing their trades on any given day at a market on close price, which I think is the ultimate form of price taking.
Okay, I'll come back to you.
Madhu, can I just add something on what you just mentioned? You were asking Ben about the US and people buying into Apple, etc. But if you pick on something which Koel mentioned about India, that last 3 years to last 5 years, a lot of active funds have struggled to deliver alpha. I think you are very, you've seen the market for long enough, so you will know more than us. Hasn't it always happened that when economic growth narrows dramatically, managers struggle to beat the index? I mean, if you see in India, for instance, you take 2018 when ILFS defaulted, you take 2019 when GDP growth was 4%, bank credit growth was practically zero. And then you see 2020 post the pandemic. I think for the last 3 years, the India's GDP growth has been in trouble. And obviously, in times of poor economic growth, it's very logical that economic performance and earnings will be narrowly concentrated with very, very few players. So obviously, active managers will struggle because by definition. So again, I'm going back to the same thing that, whenever I have worked on passive, I have always looked at the simplicity and convenience aspect. But I think it's too early to talk about India losing the ability to provide alpha opportunities. That's how I would put it. And I suspect this is a passing phase. That's how I would put it.
That's what precisely I was coming to, that, how does the investor, get the time frame? Because there are times when the active investing will do really well. Like, as I said, my phase of mutual fund investing, if I was a passive investor, I would have really missed out creating big alpha. And that lasted from 2002 to 2008 very, very nicely. And then this was a phase, as you rightly pointed out. Last 4 or 5 years, markets have been narrow, and the index investing has worked out really well. And a lot of mutual funds have not been able to beat, even the smartest of the guys have not been able to beat the index, because they have 15% weightage of Reliance in the index. As a SEBI rule, you are not allowed to buy more than 10% of any fund in one single stock. So obviously, if a company like Reliance does well, you by theory, you will underperform. So how does the investor, what does the investor do? How does he choose the time frame when the active investing will do well versus the passive investing will do well?
So I don't think that, it's really not possible to choose the time frames, but I would just put a couple of learnings out here, which is that, you have to see whether you quoted Reliance, for instance. Now, in the last 1 to 2 years, for a variety of fundamental reasons, Reliance has done fabulously well, which we all know. And it has come amidst a point in time when the rest of the economy and bulk of those sectors have, and even the darling financial services has actually struggled, which is specific to India, nothing to do with US. Second thing is, I think, apart from simplicity and complex and, convenience, you brought out a very important point that are you availing of advice or not? I think ability to pick, in 2002, ability to invest in Mr. Kela's fund would definitely have been mind-blowing advice, right? Provided that somebody actually guided you in that direction. And I think, human mind, investors, all of us, whether it is active, passive, or bull market, bear market, we all make a very common mistake that we want conclusions. We want answers in terms of black and white, right and wrong, good and bad.
You hit the nail. I'm also looking for conclusions.
But you are a veteran. You are a veteran in the stock market. You know that market is always gray. It's always trending one way or the other. There is no destination. It's always a journey where we have to live with a lot of ambiguity. Actually, very famous American philosopher said that the sign of a first-rate intelligence is the ability to live with opposing ideas
at the same time,
and
still being able to function.
Sure. So Koel, just coming to you, if you take a 5 or 10 year horizon, what are the changes which you see in both active and passive investing? And also, if you can, give us a perspective, what are the new trends which you are seeing? Is it spreading to other commodities? Is it spreading to wherein the diversification in terms of investing? What are the options which are emerging according to you worldwide and also in India?
Well, definitely, Madhu, the growth in ETFs has been pretty exponential. Globally, I think there are 2 very prominent trends that are coming up. One is what I mentioned, sustainability. I think there was a perception that sustainable companies or companies who follow such, ESG, environment, social, and corporate governance norms are just trying to be good companies. But we are seeing over time that these are companies who then over time are also able to deliver good returns and some at times better returns than others. There is a general stress and importance on ESG. So there are certain companies and countries, like you find Europe, which is very, very ESG compliant. You will have certain organizations who will not even invest if it's not ESG, and they are putting a lot of ESG criteria into their investing pattern. Not that it's kind of harming their ultimate return. We are seeing that trend flowing into India as well. Today it surprised me because I've been talking about ESG for the past 5 or 6 years, but I'm seeing last year there was a huge, inflow of adaptation of ESG into the market. Globally, there's also another trend. Of course, there are high-end, like there are AI-oriented indices that are also coming up. I think India is a bit away from that. From an India perspective, like I was mentioning, smart beta, these are nothing but factor-based indices where you are putting certain factors in. I think single factors and then multi-factor strategies, which then take both defensive and cyclical factors into play into the index to then, the thirst for, like you're saying, alpha. I think within the passive space also, I think once you meet the market beta criteria, there is a thirst for what more. And then when that what more comes, that's when these factor-based indices and factor-based concepts come into play. It's a slow and steady process in India because we are seeing that people are still liking the plain vanilla products. So last year we've seen a lot of funds come out with passive products. In fact, the S&P 500 was, I think, one of the first. It was launched in somewhere around March. It was the first digital launch right in the heart of the COVID lockdown. But I think that's where all this is kind of culminating to the digitization of processes, the digitization of the entire investment processes is actually giving a huge boost to passive. And I think if I have to see myself from 5 to 10 years, I see passive is going to take a quantum leap. But is that going to, kind of eat into the active space? I think it depends on how the market evolves. Like I said, there is a space in the large cap which is showing a lot of market efficiencies. If in Indian scenario, the market efficiencies start growing in the mid cap and the small cap segment, you will then start seeing the narrowing of the outperformance by the large cap funds, which is something that we are not only seeing in India. This kind of a report is done in 8 other major countries, and we are seeing similar trends where active fund managers are finding it more and more harder to beat passive. But that said, I think is India today at that stage? Probably not, because there's a lot of financial literacy that also one needs to take into play. And Madhu, you asked another question to Kalpen on diversification. I think why are people kind of taking passive route? Because I think it allows you to get into do that risk reward match, which if you were to just get into one stock, you are the risk concentration goes high. Like I said, it's very easy for us to sit here and take those calls, and we know that okay, this segment is doing well. Like last year, the healthcare was booming. Maybe a lot of us in our we knew how it was going. Today, the Sensex hit 50K. It's quite a momentous day for India.
Absolutely, absolutely. It's a green day for someone like me who lives in the market here.
I'm sure you have seen 3,000 levels and below.
Absolutely. Even lower than that.
Yeah. So, I'm saying if at the start of my career, I had just invested in a Sensex index fund and I just sat back and watched it. Today, I would be a completely happy person, right? I know I would have missed a lot of alpha generating opportunities, but for a layman, that's a dream come true.
Well, if you would have missed the alpha generating opportunity, but for sure you would have missed a lot of excitement.
You would have been happy just before Mr. Kela said that it was 100 times in as many in 50. Till then you would have been happy, and then you're.
So Kalpen, if I can just come to you, Kalpen, paint me a scenario for Indian mutual fund industry over the next 5-7 years. What kind of changes do you see in the industry? What are the new products which you're seeing? What are the investor behavior change which you're seeing? And what will be, let's say, the size of the industry, if we can take a guess from you, Kalpen, 5 or 10 years from now, the mutual fund industry in India?
So Madhu, you're making me an astrologer, which I'm very bad at.
No, it's not astrology, boss. It is the reason for your existence.
Okay.
I think I for one definitely believe that the size of the industry at some point of time will be 20 lakh crores. And if you go and watch my interview, even in 2003-4, I used to talk about these numbers when we were nowhere.
And it's happened. It's happened.
Yeah, it has happened, and I'm glad it has happened. I'm glad it has happened. Yes.
So I think, see, from all the macro variables of does India have money? The answer is yes. Is India's per capita GDP growing? The answer is yes. Penetration is 4% optically, though real penetration I would say is 20%, because people who can afford to invest in India above a certain threshold are not the 100 crore population. That should be, let's say, around 15 or 20 crores. So the way I see this is generally after every sharp rise in the industry, and I've seen this from after the 99 crash, 2000 crash, markets moved up, but for 3-4 years there was consolidation. Likewise, 2008 markets fell 50%, rose up 100% in 2009-10, but for 4 years there was consolidation after that. Till 2014, stocks didn't go anywhere. Will the same repeat? So if I have to just look back at that data, it makes me feel that there could be a breather for some time. There will be a phase of consolidation. And I'm marrying the last 6 months trend, last 8 month trends of continuous outflows to the extent of 20,000 crores from the fund industry on the equity side. Number one. Number two, we still are at significantly high valuation for it to act as headwinds for equity. And we are at very low interest rates for fixed income also to be very attractive. So ironically, both asset classes have a moderation of return. So the compounding may not be as good as what we have seen in the last 5 years. Last 5 years, a simple bond fund has given 10% return and equity has given 12. So, so today we are starting fixed income at 4% threshold rates and equity, forget 40p, but assume, even 30p after all the recovery. Base rates indicate that from typically these valuations at such large scale, the elephant will take time to grow. If I take 10 years forward, then the whole, every 10 years moving up by 3 times is a cycle that can continue. So I think the direction is positive, but my expectation intermediately would be a bit of consolidation in the next couple of years on one hand. The other trend that I see is Indian investors are in a fairly serious way opening up for global diversification and recognizing that if the last 10 years Indian returns versus global returns were more or less similar with same or higher volatility, then there is merit in having global stocks. I just hope we are not too late, because the same thesis in 2010 was India is emerging, BRICS is emerging, why even think of anything else? So everyone thought of India as the best country and US turned out to be the best returns market. I think time will tell. These cycles will keep moving up and down, but investors are adding more to global stocks in their portfolio. The third big trend, interesting trend I'm seeing, Madhu, is a large HNIs who normally use LRS as a route for diversifying globally. They find that limiting. If you want to take money outside and invest globally, it's operationally cumbersome, tax inefficient. So Indian mutual funds are creating a very interesting structure of 65 rupees in Indian stocks, 35 rupees in global stocks. So our thesis is that as an investor, if I can offer you the best companies of the world in a single portfolio with 65 rupees of Indian companies and 35 of global companies, so that it's tax efficient and low cost, all of this put together in 1.5, 1.75% total cost, why go anywhere else? So that category I expect to grow large. Okay. I also expect a lot of boutique money managers like you, for example, who have operated in the first phase, generating huge alpha, now challenging the traditional industry from outside, will create a tug of war. And my personal take here is that the challenge for India is not about India mein alpha ya nahi hai. Once fund sizes become large, it's not easy to generate alpha. Forget all the emotional debate about which side we are on. Look at data. What does base rate indicate? If in the last 10 years, if there are hardly 5% of funds which have generated more than 1.5% alpha. What is that indicating? And in the last 10 years, we've seen good times, bad times, flat times. So I expect
I'm
some
sorry,
of these trends to play out.
Time. My brief. I didn't realize that it's almost been 1 hour. Really got into the discussion. It was fascinating. I can tell Bijoy, who is the organizer of the show, on behalf of ET Now. Thank you for inviting me. 1 hour was really less to have this comprehensive debate or discussion with such eminent people on the participating list. So to conclude, I think it is not active versus passive. It is active and passive. It is very clear that the passive industry is here to stay and here to grow. Maybe cost, convenience, ease of products. For a layman, it is very, very easy. And there are periods of time when passive investing does well. But I, for one, believe, and I want to have the last word from the panel, I, for one, believe that in a country like India, over the next 10 years at least, you will have a lot of alpha generating opportunities. And there will be managers, you called Alpen rightly, boutique managers who will come and who will offer these products. Definitely a lot of excitement from an active investment perspective. It may not be as good as it was in last 20 years, but I'm sure there is still a lot of alpha in the next 10 years. So from an investor perspective, one thing is for sure, world is going to get more and more complex with so much information, with so many funds, active, passive, so many mutual funds, hedge funds, long short funds, commodity funds. So you will certainly need a proper advisor to advise you, because this is a specialist subject. This is not a thing which you can one day get up in the morning and say that I want to invest here. You need a proper handholding. You'll need proper asset allocation, and you'll need a good advisor to advise you on your investments over the next 10 years. So thank you very much once again to all of you for joining me today. Over to you, Jay. Thank you so much.
Thank you. Thank you.
Thank you.
Thank you so much to everyone for joining us. And Madhu, you're absolutely right. 1 hour is definitely not enough for this discussion to be held. And I'd like to thank everyone for joining us. And thank you, Madhu, for being the most eloquent moderator. So moving on, our next speaker is the Managing Editor and CEO of ICICI Prudential AMC. With more than 20 years of experience, Nimesh Shah has been the head of ICICI Prudential AMC for 13 years now and has also won the CEO of the Year award. I won't take up much time with introductions this time. Nimesh has a tricky topic to tackle: how to balance risk and return while managing investor money. And then he also has to tackle Nikunj Dalmia, who is the managing editor for ET Now, who will join Nimesh for a no words barred interview discussion after his address. But first, the speech. Hi, Nimesh.
So it's a very interesting topic, and a topic which is very near my what I do for a living. I always feel that what I work for is ICICI Prudential Risk Management Company, because when you are managing more than 4 lakh crores, it is not what all you do well that will decide your success. I believe it is what you decide not to do well which will decide your success. So we are very clear on that we have to first ensure that we don't goof up. And if we don't goof up, we'll do well. It has been consistently shown over the years that people who don't goof up really do well in the markets. That's what we would like to. And risk is something that we are, the contradiction is that we are paid to take risk. And risk is something that we'll have to take if you have to generate alpha. But what kind of risk you take is very important. And how do you manage risk? You cannot eliminate risk. The only thing you can do is manage risk, and you take the risk that you understand. So keep trying to grow your area of understanding so that you are able to take that risk. And there are a lot of things that you don't understand, and you should leave it out. It is not that whatever we don't do is something wrong. But since we would not understand that, we would not take that risk. That's the way I look at business. So it's something like test match where you leave the ball outside the off stump on a consistent basis. You need to do that. Sometimes in a T20, you may decide to play the ball. But in a test match kind of scenario, if you are in a test match, you don't play all the balls outside the off stump, and you have to learn to leave the ball. So whatever you don't understand, you need to leave. That is my one basic thing that I want to talk about. And when you are sitting in this position, it is always a challenge as to because people will have the benefit of hindsight. There is a big incident that happened in the month of April where one AMC decided to close down its funds. Till last 10 years, people were always talking about returns, and people invested very happily, saying that always we had to answer in the market that that particular fund house is giving us 2% more. Then why can't you match the rates? Why are you not able to manage the risk? You guys don't understand it properly. And it was always that you were getting more return with that particular fund house. When the schemes closed down, suddenly people saw risk only then. The risk was always there, right? But they were able to manage the risk, and it was moving well for them. So we decided not to take the risk, and we decided to stay out. For 7-8 years, people would keep on telling us that you're slow, you're not doing your things, you're not doing enough homework. Look at that guy, he does such homework. But it's a question of whether you want to take that risk or not to take the risk. Now you are in a scenario since April 20, everything has been looked at everybody has become a credit expert in the market, and everybody is questioning on every credit that we have, right? Even the AA plus credits that we have in our portfolio, it's not AAA, it is AA plus. So AA plus or AA, since where it has become very risky, people who were happily taking for 10 years, they were taking exposures in A minus and BBB are now questioning AA plus. So this risk perception is very cyclical. It stays for some time, and then back India comes to, unfortunately in India, people look at returns much more than people look at risk. That is the reality of India, and that is not going to change, right? We can have, and we try and talk more and more about risk, but we should understand that people will talk about returns, and people look at returns, because how many of us have asked our advisor that you are advising me this fund, which has one fund has given 20% return, another has given 15% return, even on the equity side? Or how many of us ask what is the risk in this fund and what is the element of risk in this fund? So risk can come in various forms. Say in January 2018, we were majorly criticized when we gave back the money in small caps, right? Small cap P ratios had gone beyond 100. So you are always in a dilemma. What do you do? The small cap P ratio has gone. There are issues coming up in the market which are raising small cap money at that point of time. And so what do? Do you raise money and you feel that it is above 100? So I feel that as a CEO, I always feel that the brand risk is a very, very important risk. We are in the business of trust, and trust is made over a period of time. So you have to protect your brand at all cost. So giving small cap money at January 2018 has its repercussion. We have got, as a fund house, ICICI Prudential has hardly got any money in small cap, mid cap today, right? But because we thought from 2016 we were negative on small cap, mid cap. For 2 years, we looked like we were not well regarded in the market, saying that you guys don't know how to manage small cap, mid cap. And we were saying, don't invest in small cap, mid cap. So in 2016, we started saying that. It took 2 years. It took 2 years to take the call right. In debt, it took 7-8 years for our call to come right. So it takes time. And in all those times when you take a risk call and you don't get into an area, it's a very painful period, because a lot of times risk may not materialize at all. So if risk does not materialize, then people will not appreciate that by taking lower risk, you took a lower return and it is okay. So while Europe appreciates that a lot, but I don't think in India, we have reached a stage whereby people ask us about the risk in that particular, like all these years, even in an equity fund, we never took in 2016-17 when NBFCs were going great guns. We decided to be out of NBFCs. We were not invested in any of the NBFCs, or most of the NBFCs, we were not invested on the equity side. And it took 3 years of underperformance, and then everything was recovered. So mutual fund cannot be, I have got a belief that people expect consistency in the market, but mutual funds cannot be consistent. Mutual funds, a good fund manager can underperform for a period of time. because he's supposed to take call before the market takes that call. He cannot be with momentum. He has to take a call which is different from the market, and he has to take that call when others are not taking the call. For the market to understand, if he's going to take with the market, he'll not outperform. So we always have this dilemma as whether you should be benchmark hugging or how far you should go from benchmark. That is called as active share. So how much will you allow your teams to take active share, and how much will it can be some fund manager can take a call that I'll take a very low active share. But if you take a very low active share, how will you beat the benchmark over a period of time? You have to beat the benchmark to take out the expenses, plus you need to give a alpha to the investor. So to do that, you will have to go away from the market. But how far will you allow the fund manager to go away from the market? So those are the various kinds of issues that will keep on coming up. And one of the another risk that I really fear as a CEO of this company is the social media risk. This is not documented in any of the textbooks, but I am very clear after April 2018, April 2020, that the biggest risk that a fund house faces is the social media risk, because all types of experts are present everywhere. And what happens with one fund house, suddenly, see what happened, one particular fund house was playing a high risk, high return category. They went into some problems, but because of which ICICI Prudential, which has never had a single delay in the last 22 years, our credit risk fund went from 12,500 crores to 6,500 crores, right? I had to redeem 6,000 crores. So liquidity is so important. A credit event can lead to liquidity risk. Interest rate risk can lead to this one, and it spreads like wildfire. Half truths, untruths spread like wildfire, and everybody will start doubting you within a period of 24 hours. That's exactly what happened. So we should never forget October 2008, and I never used to forget October 2008, but this market has given me a lot of learning even in April 2020. And when you are managing 250,000 crores of debt funds, you better remember April 2020 always, that any of your fund can go down by 50% in a span of 4 days, right? You should be fully prepared for that. See, another big risk is coming at some point of time. I don't know when. I'll give you an example. The dilemma that a CEO can be is that, see, all these years we have seen interest rates coming down. At some point of time, inflation can come back to India. When inflation comes back to India, or inflation rises or creeps up in India, will the interest rates rise? And if the interest rates rise, at that point of time, look at what has happened in the past. When interest rates have taken a turn, corporates can suddenly remove money, right? You can have huge amount of redemptions in corporates at that point of time, and we are fully prepared for that. So today, when I am sitting in January 2021, I have to take a call. At some point of time, interest rates can turn, and if interest rates turn, there can be a liquidity requirement. So I am prepared in my funds for that October, for the April 2020 incident to come again. So when we do our stress testing in our company, we try and see that if April 2020 happens again, what will we do about it? If October 2008 happens again, will we be sufficiently liquid? Because we are in a business where we have to give money in a day's time, right? We have to be prepared in 1 day. 1 day, 3 o'clock, the market will tell me that tomorrow morning I have to redeem so much. And that we have seen how much of our funds have gone out in 3-4 days time. So I think that we have to be fully prepared for this herd mentality risk, right? The social media risk and the herd mentality risk is something that we have to really worry about. And we have to be fully prepared for that, because it will happen again. You also have to bear into mind that markets are at 50,000 right now, right? So people are extremely thrilled that markets are around 50,000. But when you are investing this kind of money, what kind of calls will you take? What kind of calls frameworks you will put in the company? Always, see, these are dilemmas which will always be there. This is part of our job. If you have raised money in the recent past, right? How normally we give fund managers a sufficient time to invest the money, right? It can be, we specify also when we are raising money that we will invest over so much period of time. Now you have raised money, and in January, in the end of January, there will be a budget. how much money you will invest before the budget, how much money you will invest after the budget, how much cash call you will allow the fund managers to take. All these are risks, right? If you invest fully and the budget, suppose taxation increases and the market crashes, then you will be blamed that why did you invest fully? Or if the or the other way around, if you don't invest and the market shoots up, then investors will come back and tell us that why did you not invest? I gave you money to invest. So how do you prevent all this? So what we have realized and what we have done over a period of 22 years, we have learned a lot from the West, from the AMCs in the West, because they have been in the business for a long period of time before us. And we have Indianized and taken the care of the Indian realities. And we have Indianized those and processes have been put in place so that individual fund manager biases can be removed and the company does not go through some abnormal risk that it is not prepared to take. So I should know what is the risk that I'm ready to take. So whether it is value style of investing, how much will you and how much you will divide your funds amongst various people. So whether you are value style or growth style, how much you will allow the company to be in value style and how much will be in the growth style. You should not allow all the funds to be managed in equity. Say all the funds being managed in very similar way. You should have different styles within the company. You have to diversify yourself. A lot of criticism happens about mutual funds that you are not beating the index, right, in the last 3 years. But if in the last 3 years, the rally is a very concentrated rally, how will you be able, and mutual fund by definition have to be diversified. To manage risk, one of the biggest tools is diversification. So by nature, a mutual fund, a equity mutual fund will buy 40 to 50 stocks. You are giving a diversified bouquet to the investor, right? You have given him a diversification. When you have given diversification, you have reduced risk. When you have reduced risk and when there is a concentrated rally, suppose only 10 stocks have done all the performance and these are the 10 heavyweights in Nifty, then Nifty obviously arithmetically, those 10 stocks will be 40-50% of the market and those stocks have really run away. You can't take that kind of concentration by definition. One particular stock can be 15% in the market, in the index, but you can maximum take only 10% by law. And theoretically, we will allow even 10% to be taken on a single stock because that increases the concentration risk. So we reduce risk. When you reduce risk, and if those particular stocks go up, then by nature, a diversified fund house cannot, a diversified mutual fund cannot beat a concentrated rally. That is by nature. But how many people have written about it? Right? People have said that mutual funds are not beating the benchmark, and a lot of noise has been made about that. But has anybody said that mutual funds took lesser risk? They were diversified, so they gave lesser risk. That is why there is lesser return. All this understanding comes only on hindsight when the calls go right or the calls go wrong. If the fund house would have continued to operate the particular schemes which have been closed down, if they had continued today also, we would have been asked the question that why is your return lesser than that fund house? So whether it is equity or rest, it will always be a risk-adjusted return that we will go for our investors. And I believe that over a period of time, it works out. We have to understand we are a mutual fund. My client segment is the retired school teacher of Guwahati, right? That is, he is looking at us for a certain profile. That is my segment that I'm looking at, because we have seen whether it is an HNI or a retired school teacher in Guwahati, the ability to take risk is the pain when there is a loss is similar. So when the pain is similar, we prefer to focus on risk-adjusted return a big time. So that's where my view is. Another view is how much cash call do we allow? People as a CIO, my CIO will always have this one, that how much cash call will he allow in various funds? Because when the cash call goes right, it looks very smart. When the cash call goes wrong, the whole world will question, why did the cash call go wrong? Current market has got beautiful challenges. We are at, where are we today? We are at around 50,000, right? So past returns look good, right? Everybody can be buoyant in the market while we have skeptics in the market, and it is good to have skeptics in the market. So the current call, we are very clear that it is central bank led rally. Developed market central banks have decided that the markets have rallied, and that is why the markets are rallying. I believe that with whatever US is very, very relevant for us, and we should be continuously looking at what is happening in US to decide what will happen in our market. And if US is so liberal in whatever they are doing right now, whether fiscally or monetarily, and they are going to support their population in a big way through some reliefs, then the liquidity in the US markets will continue. So Fed is driving the rallies across the world. The rallies have not happened only in India, they have been across the world. So we are believers that of a weaker dollar, and if the dollar is remaining weak, it has been seen that the money flows to emerging markets, and with the central banks and $17 trillion in the world having negative interest rates, this kind of rally can continue. And if you have to continue at that point of time when you are managing money for the Guwahati school teacher, what kind of risk parameters are you going to do within your company? That is where I was talking about since last half an hour. So as all emerging markets are up, the inflows are deciding where the markets would be. We have seen very similar phase between 2010, 11, 12, 13. Right? 2010, the markets went up. 2011, they corrected. 2012, again, they went up. 2013, based on inflow and outflow from the market. So Nikunj will smile year to year when I again come that this volatility will continue. And as the volatility continues, we are very clear that what we have last 5 years, I've been talking to Nikunj, and continuously I've been consistently saying that you need to be in volatility advantage funds or balance advantage funds. We have created that dynamic asset allocation category, and I'm very clear to manage investors' risk. Investors will be pro-cyclical, right? Whether we won't be able to change, because human psychology works very well in that manner that it acts like a pendulum. When the greed will always overtake. In this kind of markets, people will slowly become more and more greedy. So when ET now is taking all the good things in the market, greed of people will increase and their expectations will increase. And when there is a correction, as it happened in March, April 2000, nobody was ready to invest. At that time, fear is much more than what it warrants. So this the pendulum between greed and fear will continue. So people, it is very easy to say that people have to be contra-cyclical, but human mind is not designed to be contra-cyclical. So we need to create products. I'm very, very clear. A brand like ICICI Prudential needs to create products which are contra-cyclical, so that a customer will come into the markets pro-cyclical and we can manage his wealth being contra-cyclical, because the nature of the product should be such. So we have created a host of products. Today, my asset allocation products are only invested 40% in the market. So I go and sell confidently those funds to the retired school teacher in various parts of India. And we are taking the money at this point of time, but we want to put it in contra-cyclical funds. Another way to manage the current risk can be investing in cycle funds. We came up with a strategy called business cycle fund, which would invest in sectors which we believe will do well in 2021-22. If the broad markets don't give return, while the market looks very expensive, overall basis, if you look at PE ratio, the PE ratios are much higher. But as I said, the market is very rally. If you divide the Nifty also into the top 10 companies and the remaining 40 companies, the top 10 companies have given phenomenal return, 70% return over the last 3 years, while the remaining 40% companies have given only 10% return over the last 40 years. So that is the kind of, so I believe this rally, what will happen going forward is the market will become more wider. While the broad markets won't give you, some sectors which have not worked for last so many years, I think can give returns, and the markets can become broad rally. So this is I brought in my market view right now. But one of the things that we have understood very well as I started off with, and what happened in March, April 2020, the debt funds have to manage the risk very well. I brought out the topic of interest rate risk, which can really create problems in the liquidity, can create liquidity risk within the sector, and mutual funds better be prepared for it. At ICICI Prudential, we'll manage more liquidity, because for me, it is very important. SLR, safety and liquidity are most important. Whatever is the balance is going to be returned. So my sales guy should be proudly able to say, or I should be able to come on ET now and proudly say that invest in my funds, because our funds are giving slightly lower return. Because whenever we are giving slightly lower return, we are managing the risk also in that way. Market is obsessed with Maru. There is an ad in that Kitna Deti hai. One of the car companies comes with that kind of advertisement. So the return also, mutual funds are continuously measured on that. But I feel that corporates have already learned that they are managing, they are questioning questions on risk. So I'm very happy that people are talking. We have actively gone to our markets and told about the interest rate risk that we pursued over the next 2 years, which can really change the scenario. So that's where we are. We have always avoided, the only way to manage a debt fund house is that you should avoid concentration risk. And concentration risk is not only on asset side. Asset side, you will be very disbursed. You should be very careful. What happened in April 2020 clearly showed that your liabilities should also be very diversified. Your liabilities have to be completely diversified. So all of them don't come up at the same point of time to take out money. That's a very big risk that people underappreciate. So your fund should be diversified across geographies. They should be diversified across customers. They should be diversified across distributors, so that no single person can create huge amount of redemptions and create other risks, because the liquidity risk can be created because of huge amount of redemptions coming at a single point of time. So we have always taken care of that. Another very important point is, people keep asking me that how come not a single incident has happened in ICICI Prudential in last 22 years on credit side. We have created a structure. The structure of the organization is very important. We have put a full-fledged bureaucracy. Anything below AA, there is a full-fledged bureaucracy to sign off on. The CEO has to sign off, the CIO has to sign off, the fund manager has to sign off, the risk manager has to sign off, the analyst has to sign off, and everybody has to do a physical signature after reading the whole note. Every page has to be signed. When you sign physically, it creates more consciousness. That's what I have seen. So no email approval, everything has to. So you set up a huge bureaucracy. Another very important we have done is the CIO debt reports into the CIO equity. Our overall CIO is an equity person. I believe this mixture of debt and equity, when 7 people have to sign, every person has got a different perspective. I think the debt guys are fantastic when they have to analyze the past and what is the company's behavior in the past has been. And the equity guys are very equipped to see what will happen in future or what is happening in the broader markets. People ask me, why were we not in ILFS at all? We were not in ILFS because my debt fund managers could see that what has happened, what is the balance sheet saying today. But my CIO could see that infrastructure, every infrastructure company is in problems. How come ILFS does not have a problem? How come it is a AAA, right? It is not an NBFC, it is an infrastructure company. So that structure of 7 people having to sign off, the CIO debt reporting into the CIO equity has really helped us, and various kinds of people signing off. So these are the kind of things that we have done. And one has to understand that don't go only by the credit rating agency. Credit rating agency is only an indicator. Credit ratings are only an indicator. We have learned the concept of caveat emptor, and you should be careful yourself in managing money. You should have your own internal credit rating system, whereby you are analyzing the company's risk and deciding on that. So that is what is, I think, is extremely important for the mutual funds to manage, that the organization structure of the mutual fund. Another people keep on asking us one question: what is the YTM? What is the YTM? India is obsessed with YTM. But YTM comes from various sources. If your risk levels are very high, then your YTM will look high. If you mark your portfolio mark to market and recently, then the YTM is not a true reflection of the risk that is prevalent. YTM is only giving you your future returns. Please also analyze the future risk in the portfolio. That is the extremely important thing, which was missed out by the market earlier. I hope going forward, people will always look at YTM, and with that, they will also look at risk. Please look at the portfolios. That particular funds which have closed down, the 6 fund houses had always disclosed the portfolio, right? Last 8 years, they have been disclosing the portfolio. Did people not see the portfolios? So that is the question that I would ask. I'm challenging the audience also, that please ask those questions, that one has to look at that also. I don't want to go on because anyway, Nikunj is coming. So I will take it from Nikunj now. And when you enter my office, there is a quotation that we don't have to be more smarter than anybody else. We have to be more disciplined than anybody else. So that is how you run ICICI Prudential Risk Management Company. ICICI Prudential Risk Management Company is run by being more and more disciplined, and not necessarily by being smarter than the rest of the market. So now I am ready to take the questions from Nikunj.
Good evening, everyone. Thank you, Nimish Bhai. Always a pleasure and honor to connect with you. We are speaking for the first time actually this year, so never too late to exchange pleasantries. Happy New Year to you and your team on behalf of
Same
the
to
entire
you.
Times Group and for people who are watching this entire telecast right now. Nimish Bhai, when I come to your office, there is a quote which you said, which is safety, liquidity, and return. There are also some rooms which are dedicated to investors like Harvard Marks and Peter Lynch and others. And one quote of Sir John Templeton is, markets, they always are born in pessimism, or bull markets are born in pessimism. They always thrive in skepticism, and they peak out when there is euphoria. In your assessment, purely looking at market behavior, because that's what your team does a lot, understand fear, greed, excitement, and opportunity. What stage of the market we are in?
The good thing about the market, Nikunj, right now is there are so many skeptics in the country. Right now, everybody is questioning, everybody is skeptical about what is happening and why are the markets going up. So I get so many calls. I don't see a euphoria beyond those 10 stocks that I said. I think while the overall markets are not cheap, I agree with you completely that markets are not cheap. But we have not gone into the euphoria where everybody every day wants to invest in stocks. I'm not seeing that euphoria. I'm seeing a very healthy skepticism, and I'm happy that there is so much skepticism and people are asking so many questions today before investing. So it's a healthy thing that we are having. I still feel there is space for some sectors. The market has still not, the rally can be wider than what it is today. So there is space. I think there is space in power sector. I feel there is space in the infrastructure sector. I think there is space in the energy sector. I believe that the metals have done well, but it can continue for a longer period of time. So because of whatever, for the macro understanding that we have as a company, we believe that there are spaces in the overall broader markets, not necessarily the narrow market. Broader market, there are a lot of spaces and there is a healthy skepticism in the market.
We had a chat in 2000, late 13, early 2014, when you launched a closed-ended mid and small cap fund. If you had the option to start a closed-ended mid and small cap fund, do you think the next 2 or 3 years investing for investors in a closed-ended, or for that matter, small and mid cap fund rather than a Nifty fund or equity diversified fund could be a good idea?
So we are encouraging in that rather than a NFO in a closed-ended this one. Right now, we are encouraging a lot of SIPs in SIP or systematic transfer plan over the next 6 months in the small and mid cap. We do not have a big business in small and mid cap. Still, we are encouraging people that the rally can become broader and small and mid caps can benefit out of that broader rally. Earnings can surprise us on a positive thing, and stock picking will become important. So we are okay in money coming in small and mid cap, but preferably in 6 installment or 12 installments. That would be more preferable than one-time money.
It's quite a strange pattern, which is that for the quarter gone by, we had record inflows from foreign investors and record flow from domestic institutional investors. Now, if markets in fact are euphoric, then why are domestic investors selling? And if markets are not euphoric, that why are FI is buying? Whom should we listen, and which is more data which is relevant? One is getting it wrong, one is getting it right. Ek ko samay batayega who's right, who's wrong.
It can be asset allocation also that people had invested earlier. So do we have redemptions? Yes, we have redemptions. So I think Samay Batayega, it might be an individual portfolio also, because I get so many calls from well-wishers, from friends as to what do they do? How do I advise them on the phone without understanding fully how much is he invested into equity? The advice can be different from somebody who is at 90% invested in equity and somebody who is 20% invested in equity. And what is the equity allocation he wants going forward? What is the volatility that he can take going forward? So my take on this is that every portfolio has to be seen in detail. For a foreigner, he might be deciding on his broader asset allocation that is moving out of, say, Russia and moving to India, or moving out of China and coming to India, or moving out of developed markets and coming to developing countries. There is a very macro call that those people take. Within India, people might be saying that I will book my profits. I have made money. I want to book my profits, and maybe I want to move to real estate. So that can also be a call. So we are having various kinds of calls that people are taking today. And we appreciate that if a person, but we have seen this before and we'll see this happen. For some time, there can be redemptions. People have been investing for 6 years continuously into mutual funds. From 2014 to 2020, we have had inflows. So for some time, if you have got net outflows, I'm not unduly worried. The SIP book is very intact and SIP book is going well.
Okay. I had a chat with Ruchir Sharma a couple of days ago, and he's making an interesting case, which is that 2020 was a bad year for the economy, but a great year for markets. 2021 could be a great year for the economy, but a flat to a negative year for markets. What are the chances that the economic recovery, which all of us are talking about, which is now visible, may actually happen? But when the economic recovery, when the numbers start coming out on earnings and on the macro front, markets would say, look, we knew this would happen. And markets have already moved up in anticipation of this economic recovery.
So it is a sector, as I said earlier, I said the same thing earlier. It is the sector specific calls that one takes. It's the stock specific calls that one takes. I'm those 10, 15 stocks which have done very well in the last 3 years may or may not do as well, because in those, so one has to identify the stocks where the results have already been discounted and the stocks where the results have not been discounted. So old style equity research and picking the right stocks and picking the right sectors is what will play out. I think broad market, I don't have a very different view from what you said, but there is enough space in the market to move on, right? Even amongst the financial, if we say the financial sector, we have got a very varied opinion even in the financial sector. I believe that whatever has happened in the last 1 year in the company, would a certain strata of our society has got affected because of what has happened, right? Their businesses are seriously affected. There are job losses in the small sector has been really badly affected in the country. The government is supporting them, but there are job losses in the unorganized sector. So if there are those kind of scenarios, so the CFOs of corporates might be smiling year to year, right? But the unorganized sector might have issues, and people who have given finances to low. So when I'm bullish about financial sector, I'm not bullish as a fund house. ICICI Prudential is not bullish on financiers who have given money to the absolute lower strata of the society. I believe that defaults can be higher in the lower strata of society vis-a-vis the banks which have concentrated on the mid segment of the society or the upper end of the society. So the bottom of the pyramid, there will be pain, and where people have done those kind of lending, one has to be more careful. Then so I can't give you a broad call even in the financial space. I will give a nuanced call that some spaces within that, the kind of lending practices you had will decide the winners. But there are definitely winners coming out in the next 2 years in the financial services will be clear. I think that's what I feel.
I'm going to take the clock back and then take the clock forward. Today, Sensex has touched 50,000. So it's a landmark day. And for those who are associated with the market, you're getting this ring of 50,000, which is a good feeling. I know it's a number, but 50,000 Sensex, it's a special feeling. Few years ago, financials had a very low representation in the Sensex. Index was dominated by commodity and other sectors, but the composition of the Sensex is changing. We are starting a new decade. If we have to get into this conversation after 4 or 5 years, how do you see the composition of the index changing? Because that, in a sense, will tell us which way winners will emerge and which way losers will come.
I think the markets will be more broader than today, where one particular stock cannot be 14-15%. I think the markets will get broader and broader, and we will have more, say one sector in this country, which has to be represented. If you see anywhere in the world, real estate is a very serious sector, which is there always a part of real estate, and infrastructure companies are a very healthy part of any index. What has happened over the last 13 years, those industries are completely out of index completely. I think those sectors will come back. I think cyclicals will have a bigger role to play in the index when we see 4 years down the line. It will be different than financial services. While financial services are very important in India, I think the composition will be more balanced, I should say.
Why should one invest in debt schemes? Because if at all interest rates from here will go higher, and if at all inflation will come back. So both the factors which always impact mutual funds are not supportive for a medium to a long-term investor.
So debt funds, that's what Nikunj, when I was giving my talk, I very clearly said that we expect interest rate in the next 3 years. When I recommend to people, I always, because it is tax advantageous that you come in mutual fund, debt mutual fund only for a period of 3 years. So today you should be taking a 3-year call and only coming into the market. So we are fully prepared that interest rate reversal can happen in those 3 years. I don't know when it will happen. I don't know whether it will happen in 6 months, 1 year or 2 years. I am not aware of that. But we would reduce. There are some, say there is a fund called all season bond funds, ICICI Prudential all season bond funds. So we have the leeway to reduce duration big time in that. So we don't expect anyway. We are very, we have been very good when the whole credit cycle happened in mutual funds. We were not caught on the credit side. Now we are fully prepared that there is an interest rate risk coming into the market, and have we reduced duration to whatever is required for the investor's interest. So we have on our own, we have reduced durations. So I don't think there is much scope of interest rate going down from here. So why would I want to play a high duration? I have been playing whatever least possible durations we are playing. So, and what I have to beat, do not look at when you look at a return of 7%, you have to see 7% vis-a-vis what other competing products are giving. It's not that only mutual funds. From 3 years from now, where else will you get a return which my YTM minus the mark to market loss that you can have for a low duration will give? You have to match that. So we also see that now we know what are the returns that a person can get in other competing products in the market, and vis-a-vis is my YTM minus expenses more than that. And another factor is that debt funds have got a 3-year tax advantage also vis-a-vis traditional instruments, right? So there is an advantage if you do the mathematics, and I think I'm sure your advisors can do the mathematics. ET can run that mathematics. That mathematics is very clear that post-tax and post-expenses, our expenses, also if we run low duration funds, the interest rate risk will not affect us to that extent.
Fair point, great point. So let's spend some time understanding risk. Now, what an investor can do is perhaps change and tweak asset allocation depending on valuations and the macros. So for equity investor, if you actually batted on the front foot, let's say between March and April, or March or May or June, you were rewarded. Is it still time to bat on the front foot, or time to take a step back and go back to the back foot?
So out of 10 times I've come to ET now, 9 times I've said the same thing, except March, April. I always said asset allocation products. So this is not the time for complete equity products. I would strongly recommend either you go, but this is not somebody is not into equity can get into equity funds also. I'll come to that. But otherwise, equity investor should be in asset allocation products where we have the discretion to move how much into equity. As the markets go up, I can still reduce my equity from 40 to 30 to there are fund of funds. Even it's known as ICICI Prudential Asset Allocator Fund. We can bring equity to zero. We were in March, we were at 70% plus in that. Today we are at 40% in that, and we can go down to zero also in that at some point of time. So there is an asset allocator whole idea that one should be in. One can be in business cycle idea, right? So we have come up with those ideas that allow us to take sector calls. If you are knowledgeable about equities, then allow us to take sector calls, and we can make money out of taking sector calls rather than investing. If you give me into a broad fund, I have to respect all sectors and be invested in all sectors. I can't take complete deviations over there because my fund boundary lines won't allow me to do that. My risk management will ensure that I invest in all sectors. But in this kind of funds, which are designed to invest in different sectors. Another very interesting thing is coming up is fund of funds. We have got our fund of funds. So there is a global advantage fund of funds where we not only invest in our funds, we invest in competition products also. So I can invest in a Templeton International Fund also. I can invest in any other mutual fund in the country. That mutual fund we can invest. So you invest for 3 years with me, and I in turn will invest for you. Based on the macroeconomics of various countries, we can do country allocation. So international investing is one theme that one can play in fund of funds. So I think fund of funds will become big in the years to come. Right now, with the levels of the market, the risk that one should take for a normal equity investor, for a normal guy who's always into equity or who is already into equity, I would strongly recommend asset allocation products and not pure equity products. or business cycle fund. That are the kind of things that I would recommend. And people who are not invested and people who understands the risk of mid cap and small cap, they have not run away. That is, there is still stock picking possible over there. So mid cap and small cap over the next 6 months can also be a good space to be in.
Okay. I'm just going to hit the pause button here, and I'm just going to encourage as many questions for people who want to participate in this live broadcast. In fact, I've got some questions and quite relevant questions. So thank you for those questions. First question, Nimish Bhai, is, are active funds likely to lose market share to passive funds?
See, I just explained, and I'm happy that this question has been asked again. In the last 3 years, there has been a narrow rally, right? The top 10 stocks, if you see the Nifty, I'll repeat some data. The top 10 stocks would have gone up by 70% in the last 3 years, while the market has gone up 30% only, because the remaining 40 stocks have gone up only 10% in the last 3 years. So it has been a narrow rally. Just see the arithmetics of it. Mutual funds have to be diversified in 40 stocks, right? We do not run concentration risk. So we are diversified. So diversified instrument will not be able to beat concentrated if the rally is very concentrated. So that is what has happened in the last 3 years. If we don't beat the benchmark over a period of time, then definitely passive will become more bigger and bigger. So we are very conscious of that. And we are very conscious of controlling the risk also. In one particular company, I cannot invest 14% just because the index has got 14% weightage over there. By law also, I cannot invest. SEBI regulations only say that I can invest maximum 10% in a stock. I cannot invest more than. So just because, and that company would have had a phenomenal run in the last 3 years. So what do? You, by design, you will underperform. So that should not be a worry. You see the long-term track record that we would have had. And I come and just see the arithmetics of what I have said. Please verify yourself. Arithmetics is best done by yourself. When you do arithmetics yourself, you become more clear on that. So what arithmetics I have said, please check yourself, and the answer is over there. So I believe that India has got a very fine set of fund managers, and active should continue to do well. But if we don't do well, then definitely passive will overtake us.
But do you think that for someone who's, let's say, coming by the distributor channel and is taking advice, after paying the distributor fee and the AMC fee, you're reasonably confident that it's worth coming to an active fund?
Yeah, see, mutual funds have done well only because it has become a very pure product. SEBI has done fantastic regulation management, whereby hand on heart, every product is right for the customer because it is very transparent. Even the funds which had a problem had transparently disclosed the portfolio. Right. So I feel that it is a transparent product where the expenses are also known. If we do not generate that kind of alpha, we'll have to reduce our expenses also. Expenses are continuously coming down in India. That is also a very healthy sign. I believe India is all about volume. It is not about margins. So I'm very happy to say that our margins have come down dramatically in the last 3 years and will come down further. Right. And we are quite okay with the margins coming down. Every year my margins are coming down and we are okay with our margins coming down. And I think over a period of time, with what we have done in things like balance advantage fund, with things like business cycle fund, with things like fund of funds, we will be able to give a good proposition to the investor. This industry is so transparent that we don't have a business if we have not done well for the customer. Right? It's a beautiful industry which is completely transparent to the customer. It is doing well for the country and it is doing well for the shareholders. We have to balance everybody. So as I said, risk is all about balancing.
Of course. Balancing and managing risk also, something which, we always undermine. The importance of risk is something we always undermine. In a bull market, we get excited. In a bear market, we get fearful. I think that's something we've learned over the years. My next question, Nimish Bhai, is balance advantage fund. This is a unique scheme which in a sense was coined by your fund house, and it's we have a sizable market share.
Now it's a category.
It's a category now. In the balance advantage schemes, I understand that the schemes were big buyers in the March and the April fall. What is the positioning of the balance advantage schemes now? Because that in a sense just will epitomize your market view and your asset allocation now.
Correct. So we were more around 70% in the month of April when the markets had go down. Maximum it could have gone up to 80%. Today, minimum we can be at 30% in that fund, but we are at around 40%. Some 39% or 40% is today it would have gone down further, slightly more, because if the markets go up, they automatically sell. It's the algorithm which works. So I think will be around 38-39% will be there today. So that reflects our market view also, as Nikun said, that we need to be careful in this kind of markets.
You've not used the word internet or digital, because that's where all the movement or excitement is. You are a digital savvy person. We've interacted. You are trying to adopt technology. Mutual funds have adopted technology during the lockdown. How come you've used sectors like power, cement, business cycle gainers, but not, no, you've not said that, okay, I'll launch an internet fund or I will launch an e-commerce fund? How come not thinking on those lines?
You got a right question. We are in the listed space. We are not in the non-listed space. In the listed space, whatever is available, that is what we can buy. Till now, those loss-making companies in the e-commerce space have yet not come into the markets in that manner. There is one company which is doing very well, which is valued quite well. Otherwise, there is not huge amount of space right now available over there. But I'm sure companies are coming in, and those will be exciting. That will challenge our stock picking abilities also. Are we used to invest in companies which have made losses and which have got a bright future? So we have got a lot of young analysts, right, already analyzing those sectors. As more and more company in the new world come into the listed space, we are well equipped to manage them. We are already tracking them in the private equity space, what is happening on the private equity space. At some point of time, they'll come into the public. We have equip ourselves to manage in those companies. But technology call we had given, the software companies that we have got, that call we had come onto your channel also, and my CI had come and given that call that we are very bullish. 6 months back, we had come and told you that we want to invest in technology stocks. At that time, now it has run up. So right now, you are right. I have not used the word at all till now. Pharma, we are saying big time 1 year back. I have not used the pharma at all. Right. So what has worked out? What's the point in putting investors' money in that? I would rather invest in, see, why we believe that in this kind of expensive market, you should invest where you will not lose money. I feel utilities in India are superb. If you see the power sector in India, right, available at a company which is managing 50% of the power is well governed. The governance standard of that companies are very good. The management is smart. Management knows it is doing, and they have got 50% power, 50% capacity in India. Is that there is no India without that company. That company is available at a single digit PE. That the company is available at a dividend yield which is much better than the bond yield. The bond yield, that company gives a better dividend yield than the bond yield. So good dividend yield available at a single digit company. Our research says that the EPS of the company can go up 40%, because as soon as the capital work in progress gets converted into a power plant, it gets a return of 15.5% from the government. It is documented for the next 5 years. Market profits are assured. So profit, where do you get this kind of sector? Single digit PE, dividend yield, which is very good. On top of that, earning expected to rise because of government, the product will sell and the money will come in, right? The ROE is given. The government has given the ROE to that company. So what is the problem in investing in those kind of companies? Can you make a good return out of those kind of companies? Yes, you can make good return out. So we had invested in the oil company in the last 3 months, you have seen. So last 3 months, if you see us, we are smiling much more than what we were smiling earlier post-September. Because market, look at what has happened in the last 3 months. Market is getting wider. Companies which had not worked earlier have been working in the last 3 months. And I believe this momentum is continuing.
Okay. When 5 minutes are left, I'm going to just start taking a lot of viewer questions. I've got a lot of viewer questions. I'm reserving some of them for the last leg because they are centered around how to pick up a good fund manager and what is the ethos of a good scheme. But I just want to wrap it up with one follow-up question, which is that when interest rates are low, and which they could remain low, for those who are buying stocks at P multiples of 50, 60, 70 plus, they are justifying low interest rates as the new normal, which we've not seen before. Earlier, interest rates would move in a cycle. As a result, you would buy stocks which were cheap, which were trading below the replacement cost, and when things would normalize, you would sell them. But what is the future for value? What is the future of interest sensitive, cyclicals, when everything around us is changing so rapidly and the environment is also a very low interest rate environment?
So when interest rates are so low or have come down, who will benefit the most? The cyclical companies have borrowed big time. right? The cyclical companies have borrowed big time and they are the ones to benefit. And we are seeing the smiles on the CFO's face when they come and talk to us, that we are seeing. So I believe that value investing, that what, see in India, till now I have not been able to convince people. People don't ask which company, which is a good AMC, which has got a good fund manager who's managing the fund since a long time and has given a long-term track record, which is good, but last 1 year is underperformed. Look at data, analyze some data. Last 1 year underperformance is not a thing to worry about, right? If the fund manager is good, the fund management company has been in the business for a long period of time, it's a good brand. And after that, the fund manager has underperformed for 1 or 2 years, it might be a great time to enter that fund because the P ratios, you are buying relatively cheaper stocks in that, right? Those, when you are buying a fund which has done very well in the last 1 year, already those stocks have worked and the PE of that fund will be high. So will you buy a low PE? But I have not been able to convince people. I myself do that and it has worked beautifully well, that invest with a good fund manager when or a good company when the 1 year performance is not all that good. So I have not gone, it has been doing very well, that particular strategy. You can see the statistics on that, it will do well. So I believe, well, as I said earlier, 10-15 stocks have done very well. The rally is getting broader, but the remaining 40 stocks have got a lot of steam left out. And that 40 stocks and the mid caps will work now. And
so
then
we should buy.
Nikunj will not ask me this question, that why are mutual funds not underperforming the benchmark? I am waiting because till 2018-19, I used to come very proudly and tell him that 100% of our funds are beating the benchmark. Right? I have had those interviews also with Nikunj. So I am waiting for me to come and say the same thing again on ET now. So that's what I'm waiting for.
I'm sure it'll happen, but I'm going to just take some viewer questions. I mean, audience questions here, not viewer questions. How do you pick up a fund manager? I think there are about 45 AMCs in India. If we start adding up the schemes, the number will run into dozens and hundreds. I've honestly lost count of that number. How does one go about picking up a good fund manager? Because every fund manager
I'll tell you, we manufacture fund managers. I'll tell you, at ICICI Prudential, we don't recruit fund managers from outside. Till now, we have not done it. In future, we can do it. But till now, we have only manufactured fund managers. We take young people from IITs, we take people from IIMs, we take rank holder chartered accountants, and we make them analysts. Over a period of 5-7 years, they rotate through various departments of the various sectors within investments. After they have seen 5, 6, 7 sectors, then they can get a job as a small fund manager and then graduate to become fund manager. So that's how so you have to go by the one past track record is an only indicator how that guy has managed in the past. It is not an end in itself. It is a useful tool. Past track record is a use. So a good AMC will have, one has to also see, suppose one of my fund manager leaves the company. Will it happen? It will happen in future also that fund managers can leave the company. So if a fund manager, does the brand have the strength to hire somebody else in his place? It is very important to know that when one fund manager leaves ICICI Prudential, I get 40 calls from the market that we would like to join. So is the brand strong enough to attract the best talent in the country? Right? So India has got a lot of talent in every sector. India has got a lot of talent. So with a young and aspirational India, will there be a churn? But yes, there will be a churn. So you are giving money to ICICI Prudential AMC, and we are ensuring that a good fund manager will be managing the money, right? So that goes on the brand. So you should trust the brand. You have to see the past track record of the brand, whether it is worth trusting, it is trustable or not. So when you are managing in a debt fund, if you are investing in a debt fund, will you see or not that last 22 years, this company has not had a single day's delay? So you will see that, right? So that is only an indicator. That does not mean that in future I will not have a problem, but that indicates that I have got robust processes which have worked in the past.
Fair point. I've been meaning to ask you this question even when we've interacted, but never got a chance to speak to you. You mentioned the word global allocation, and one should allocate globally because times have changed, borders have come down, and innovation is happening everywhere in the world. How does one go about understanding global allocation? Because in India, we follow a simple formula: understand your risk, age minus is equities, remaining goes into debt. When you throw in an angle of global allocation, from what quota should it go? Is that considered high risk? Is that considered low risk? Because globally you want to invest, but how do you quantify that risk in your portfolio?
So once a very senior CIO from Prudential told me, when I am talking about the year 2007, when I was trying to explain him what great things India is going to do, etc. He told me, he said, we have to identify the country right. If you identify the country right, 90% of the return comes out of identifying the company right. Then comes the fund manager. Which fund manager you give within that will give you 10% more return. That's what his call was. That if you identify the company right, all the returns are made because currency will make you return, the sector will make you return, etc., etc. So we have got a team of great macro thinkers. I think Naren, my CIO, is a fantastic macro thinker. I've worked with him for 13 years. Anish is another person who's a very good macro thinker. So we have got a set of people who are macro thinkers. So what we thought that we have the benefit of all these people. So they can understand macroeconomics of which country. They can understand where is the current account deficit of the country, where is the fiscal deficit of the country. So broad economics, they understand very well. And then we can identify a good fund also there. So what we said, let's do a global fund of funds where we don't have the expertise of Russia. We don't have the expertise of, say, Hong Kong. We don't have the expertise of US. But can we create funds? Can we have strategies? We have got a US blue chip fund. I will just spend 2 minutes on this. In 2012, this has been my biggest marketing failure. In 2012, we launched ICICI Prudential US blue chip fund. Nikunj has heard this story before. I did 30 roadshows across the country. I traveled to 30 different towns, did roadshows, and then we collected only 32 crores in that fund. 30 roadshows and only 32 crore. We could not convince. See, at that time, we expected that dollar will do well. We expected US had not given return over 7 years or over 4 years. People were just not ready to invest in US funds. But that was such a fantastic, it was only a macro call. It was a macro call that US will strengthen from here and the rupee will depreciate. India's current account deficit was very high at that point of time. Remember 2012. Yes. So India's current account, it was a sitter of a call, but we were not able to convince people. After US blue chip fund has given fantastic return over last 7 years, people have started investing in US blue chip fund. But still it's a trickle. I think we also need to market again that concept well. Let me fail again. We'll try again. We are setting up another sales outfit or a product outfit within ICICI Prudential to come and market this macro investing funds, which take macro calls on countries and invest. And I believe that we have to leave it to I don't think individuals can go and analyze 14 countries in the world and decide what sector and which country to this one. This will have to be left to professionals who do macro thinking for a living. That's what my sense is. I'm not promoting my business, but please look at ICICI Prudential Global Advantage Fund. It will give you a flavor of what we are doing.
Okay, so I'm tempted to ask you one last question, maybe another 30 seconds, won't extend my appointment beyond that. The regulatory restrictions are mutual funds can't stocks, but there is no regulatory restrictions on the countries. So if you have to take a bet on one country for next 5 years, apart from India, which would be your country based on your studies? Because you were very clear about buying a US feeder fund. Now let's talk about something which regulator permits you and something where you can give me a straight view.
See, right now, more than countries, there are sectors and so
you're dodging my question, sir. Now you're dodging my question.
No, I'm within the country, within international investing only I'm talking about. I'm not evading the question. I'm telling you within international investing itself, since we have got a view on oil, we have got a positive view on oil that it is a good time to invest in oil. So those in turn, we have gone and invested in those economies which benefit by oil prices going up. It's a perfect hedge also for Indians, right? Our country will do well if oil goes down. Our country will do badly if oil goes up. So we should invest in things which can hedge the portfolio in India, right? So sectors which are invested in oil, sectors which are invested in, now technology has run up big time in US. Otherwise, one of our competitors has got that NASDAQ fund. That was also a good sector. So we go by macro thinking on sectors. And we have identified some countries. We have invested in Hong Kong index. Right now, we have invested in Hong Kong index. We have invested in Templeton Asia Fund also. So there are a couple of 4 or 5 investments that we have done in those, which should be looked at.
Well, really appreciate your time. We started by your understanding on risk, spoke a lot about the debt fund, and we wrapped it up with something on international investing. How interesting the world is changing. Sitting here, you can take a bet on Hong Kong, invest in debt mutual funds, understand the risk, but that's the new world we are in, completely digital. I've always interacted with Nimish in close proximity, but even though I'm interacting for the first time on the digital platform, the joy of interacting with him is always the same. Really appreciate your time and thank you very much.
Thank you.
With that, I'll just give it to Purvi. Purvi, please take over.
Thank you so much, Nikunj, for that engaging discussion. And thank you so much, Nimesh, for joining us today. Nimesh is the MD and CEO of ICICI Prudential AMC. And I think I speak for everyone when I say that your pendulum metaphor about the counter-cyclical returns was quite informative, if not colorful. And again, I'd like to thank Nikunj for that really, really engaging Q&A. Moving on, we have a really special session with Staff Fund Manager Prashant Jain, who is the Executive Director and Chief Investment Officer at HDFC AMC. Prashant actually needs no introduction for Indian investors, and he has been very kind to be part of this event for a second time. He will address an interesting topic in his speech, which is investing in times of low interest rates. Bijoy Saike, the editor of ETMarkets, our very own, will be joining him for the Q&A session after the speech. Hi, Prashant. Hello. Hello, Prashant. Hello.
Hello.
Hi, yes, you're audible now.
Yes.
All right, over to you.
Yes. Good evening, friends, and thank you, ET, for giving me this opportunity to share some thoughts on this very prestigious platform. And I have a couple of slides, and after that, I'll be happy to engage for any thoughts or questions that are there. Just 1 second. This slide basically represents how the global and the Indian and the global economy is recovering. And I think almost all the leading indicators are suggesting a smart recovery in India, as you can see on the table at the top. And even the global economy seems to be recovering quite well, though it is interesting to note that the emerging markets recovery is ahead of the developed markets recovery. And also manufacturing globally is recovering faster than services, which is understandable because services do involve some contact and eating out, travel, etc. And therefore manufacturing seems to be making a comeback faster. One surprising development has been the sharp recovery in metal prices. And there are many reasons for this, but indeed this has been quite unexpected. And now many metal prices are ahead of pre-COVID levels. And this is one example why forecasting things is quite challenging, as this example suggests. I think the recovery in Indian equities has surprised most people. And even I am surprised by the strength of the recovery. While we were positive on the markets in period of lockdown, mainly driven by the temporary impact of lockdown and also the valuations. Nevertheless, I think it is appropriate to say that the recovery has surprised most people. So what has driven this recovery? One, I think we must appreciate that even at current levels, the market cap to GDP of India is not excessive. as you can see in the table in the chart at the top. It is interesting to note that at the bottom of the markets had fallen close to 50% market cap to GDP, which you will appreciate was clearly an outstanding opportunity and an unsustainable level for markets to trade. And I think that 48% or 50% market cap to GDP, I think the recovery from those levels has to be seen in that context, that when things fall just too low, the recovery is inevitable, even if economic conditions continue to be challenging. It is also interesting to note that at current levels, the 10 and 15-year returns of Nifty are between 9 to 12%, which is in line with the longer term GDP growth, the rupee GDP growth of the economy. And this is again telling us that the markets are not expensive. In fact, they are closer to longer term averages. The profits of companies have surprised most analysts, most fund managers. And I think companies have surprised markets by the cost savings, by the improvement in margins, and corporate profitability has clearly behaved better than what was expected. And I think finally, the most important factor is the cost of capital. Because of COVID and the ensuing economic conditions, the cost of capital both in India and outside India has collapsed, has come down quite sharply. And this has a bearing on all assets, especially equities, because as you know, if cost of capital falls, the fair value of the same cash flow stream goes up. So I think the recovery of the markets and the view going forward should be, if you consider these factors, then I don't think the markets are excessively valued. And this is a very simple illustration of the cost of capital, because most people focus on the economic conditions, the difficulties being faced, and most people they don't really objectively look at things when it comes to cost of capital. So this is a very simple slide, and we have taken a couple of scenarios here. These are illustrative examples, and you can clearly see that how the fair value increases between 10 to 20% for different levels of fall in cost of capital. And I will not go into the details of this, but you could refer to this later on. But this is an extremely simple illustration just to drive home the point that please don't look at equities or valuations in isolation of the cost of capital, because that has been one of the most important drivers of equities both in India and globally. The interesting thing about this rally in the markets has been, in fact, this is true for returns over last couple of years, is that certain big stocks have driven most of the Nifty returns. And if you look at calendar 18, 19, and 20, 150%, 81, and 81% of returns in these 3 years of Nifty were delivered by just 5 stocks. And this has also made life pretty difficult for active managers, because when markets are so polarized, it becomes difficult to beat them with more diversified portfolios. The chart at the bottom is conveying the same message in a different form. This is the contribution of Nifty 50 stocks to the overall market cap. And as you can see, because the Nifty returns were driven by select stocks, the market returns were driven by select stocks, the contribution of Nifty to overall market cap hit an near all-time highs. And I think what I would expect after a returns like this is for the markets to become more broad-based. And that is what we seem to be experiencing over the last couple of weeks. I think this is an interesting chart, and let me take a minute to explain what we are trying to convey here. We have looked at the various sectors, and all the sectors are listed at the top. The current valuations are given in the top row. The 10-year average valuations are in the next row, and the current premium or discount to the long-term averages is the last row. And what is interesting to see is that some sectors like automobiles, consumer staples are trading at very high premiums to last 10-year averages, even consumer discretionary. And some of the sectors on the right are trading at significant discounts to long-term averages. And the way we have arranged these sectors is at the left is the highest premium, and you go down to the highest discounts as you move to the right. The similar message is there in the chart at the bottom, and this is basically the standard deviation or the divergence of valuations across sectors. And you can see that this divergence is at the highest ever in the last 10 years. So I think this is one unique aspect of this market, that the gap in valuations across sectors is one of the highest that I have experienced in a long time. And this does pose a very, it's a very opinion is sharply divided, which way the markets will move in the future, whether there will be mean reversion or not. And I certainly have some thoughts around that, but I'm sure there are people who think just the opposite. I think let me just step back, because today the index touched briefly 50,000, and again this question comes back: should one invest in equities? What should one do? So I thought, let me step back and take this opportunity to share in my judgment, what is the right way to look at equities. So as you know, probably Sensex started in 79, and if you look at the total returns index, it has compounded at 15% over last 20 years, and slightly lower levels since inception. And in last 20 years, this 100 rupees in the Sensex has become 1615 nominal terms and 516 real terms. And I think the message if you look at the chart at the right, the blue line is the total return in the index, and the red line is the Sensex index. And because people relate more to the Sensex, and if you add 2% a year roughly, that becomes a total return index. That's why we have given you both the indices here. And I think what people have done over last 20, 30, 40 years, people have moved in and moved out of equities a number of times. But in my judgment, the smartest investors have been who have been very, very patient. And when timing the markets is always extremely difficult. And even when markets have turned expensive over time due to a growing economy, companies that are growing, the valuations become less important. And if you go back and see in 1992, the index used to trade at 40 times. And that was one of the highest multiples that the index has traded at. Even from those levels, if you see the index, though for 8-10 years it did not generate returns, but if you held longer than that, the returns have turned out to be reasonable even from 40 Ps. So I think the message is very simple, that it's very hard to time equities, and over time, patience inevitably pays in equities. One way to improve returns in equities, and we have experienced this a number of times, is that around some difficult environment, around times when there are challenges in the environment, the Nifty or the index corrects sharply, as has happened in 2001 around Lehman crisis, Brexit, tapering, etc., and most recently due to COVID. If you invested on any of these occasions, you can see in the table in the middle, the CAGR returns improved materially from these lower entry points over the long-term averages. So I think the key message I want to share here is that equities are a simple asset class. For the patient investors, they represent a growing economy over time. And one way to improve returns is to wait for crisis type of events. And if these crises, the effect of these crises is temporary or not meaningful on the economy, then the medium to long term view, investments made around these times, you can see on every single case have delivered meaningfully superior returns. And the reason I shared this slide is because day in and day out, there are questions like, is it the index too high? Are the multiples too high? So I think this is one way to just step back and get the big picture right. This is another very topical issue, and value investors are in a very difficult position. And I have also, in a ways, I have a value bias, and that has caused some pain to the portfolios that I run also. But in last 10 years, even globally, value investing has not done well, and it remains an open issue whether this is a new normal or there will be mean reversion. And I don't think I have views on this, but I think only time can provide an answer to this issue. But this is indeed a very live issue. But on a similar thought, let me share with you how this market is positioned at two extremes. This is an example of two companies, one a leading consumer staples company and one a leading utility. And you can see from how the valuations have diverged in the last 10, 12 years. From multiples that were not too different around 2007-8, you can see the former is trading close to 55 odd times or 60 times, and the utility is trading closer to 5 odd P, 5, 6 P. The dividend yield on the utility is around 7%, and the dividend yield on the consumer staple company is around 1.5%. And the growth in these two businesses is not too different. So it would be interesting to observe whether this does correct or this current state of affairs continues. And I would, I mean, all of us have views, but I think only time can give the right answer. To summarize, I think the COVID clearly was a black swan event, and while it did impact the economy, I think it was not too hard to guess that the impact on the economy would be temporary. And that's why I thought one should have been positive in equities, and that's what we did. But of course, these views are always made with a medium to long-term view. I think the cost of capital, which has collapsed as a result of COVID, has had a very favorable impact on equities, and the current valuations, at least even in some of the expensive sectors, can be somewhat justified if you work with fairly low cost of capital. So if cost of capital was to move up over time, I think that would pose some risk to markets, especially to the expensive sectors. I think one surprising development of this year was that the resilience of the earnings, and earnings will actually are likely to grow this year against contrary expectations towards the beginning of the year. So I think corporate India has handled this situation extremely well, especially the large companies. And despite the big rally in the markets, our long-term average, long-term returns are near nominal GDP growth rates. The market cap to GDP is at neither cheap nor expensive. I would say it is just about right. And therefore, I feel that if you take a medium to long-term view, markets hold promise. And especially given the low cost of capital, I think it should be possible for equities to outperform bonds. What are the risks? I think the world over interest rates are probably unsustainably low, and liquidity is at record levels, probably unsustainable again. And if this pace of normalization of interest rates or liquidity is faster than what the markets expect or are discounting, then that could pose some risks to the markets. And let me now just share before I end few thoughts which I think are interesting and topical, moving slightly away from equities. This is a very live issue with electric vehicles on the horizon. Should oil prices come down or could they go up? I think if you look at, people are simply, many of us, we simply assume that as electric vehicles come, the demand for oil will go down and therefore oil prices should go down. The interesting point here is that even the producers of oil, even the suppliers of oil know this. So I think the key is how much do the investments come down in new oil wells to expand supplies. And as you can see in the chart in the middle, E&P capex is down pretty sharply, and the penetration of electric vehicles last year in sales was just about 4%. And even if it goes to 15-20%, which is expected over next few years, till 2030, we think the population of ICE vehicles will continue to grow, and therefore the demand for oil will continue to rise for a considerable period of time. It is also interesting to note that normally oil wells deplete, or the flow reduces by 5 to 7% a year. So if you stop investing, oil production will come down by 5 to 7% a year. So you need to continuously invest even to maintain production. And therefore, we think if supply or investments fall faster than demand, there is a possibility that oil prices could move up. And there is an interesting piece of information here. The demand for mercury peaked in 1970 and it fell by 80% by 2012. And in the period 2004 to 12, despite lower demand, the prices of mercury spiked up almost 11 times. And the value of production was same as that between 65 to 70. And this obviously happened because investments also must have fallen very sharply. So oil is a very important variable for India, and I think we should watch this space with interest. This is another very topical issue, and people think that, and there is an opinion that thermal power has a bleak future and solar power is the answer. Solar is certainly environmentally clean and extremely desirable, but there are certain very serious limitations presently. The chart at the top right, it gives you the variation in the demand of power in India over a typical day, over 24 hours. And unlike in the West, where air conditioning is the main source of demand, in India, the air conditioning is there in only 5% of the homes in India. And therefore, in the evening times, when lights go on, the power demand peaks. So power demand in India peaks between 5 to 9 on a daily basis. And at this time, there is no sun. And that's, I mean, sun should not be there when you are putting on lights, right? So this is a bottleneck to wider adoption of solar power, because unless you have cheap storage, economically viable storage, solar power is not the answer to meet these demands in the evening times. And storage is still about 10 rupees per unit. And we think it will take quite a while before solar power becomes is able to meet demand on a 24/7 basis. And given this very high expensive or very expensive storage, we think demand for thermal power in India will continue to grow. Recently, CEA, the Central Electricity Authority, came out with the most comprehensive report on this issue, and we have summarized the findings, their findings in the last para. And they say if electricity demand grows at 6% per year, and if we achieve 430 gigawatts of renewable capacity, which is an aggressive target, even if we achieve that, the coal demand will still grow by 3% a year. And by chance, if electricity demand, this is our calculation, if grows by 1% more, the power demand growth will be 5%. As we all know, last several years, no new thermal plants are being set up, and capital is clearly moving away from this sector. So I hope that we don't face a shortage of power sometimes in the future. But I don't think we can rule out that scenario, because whenever in an environment of growing demand, you underinvest, over time it is possible that demand may outstrip supply. I think this I have already covered, and there are a lot of media reports that focus on the cost of solar power uh, uh, across new tenders. And the point to note here is that this power is just the cost of power. It does not include the cost of storage. And there are also certain subsidies around transmission, etc., that are currently the system is bearing. And there is one more point to be noted here, that currently the interest rates are extremely low. And in solar power, the main cost is interest cost. If interest rates move up, it would be reasonable to expect that this cost may not sustain over a full interest rate cycle. And as you can see, the effective cost of solar, if you build in the interstate transmission and the backing down of the thermal plant, because you will need thermal plants for evening time, and during the day, if you run them less, the cost of the thermal power goes up. If you add up all of that, then thermal power is not as cheap. I'm sorry, solar power is not as cheap as a simple analysis or the headlines suggest. I think one or two last slides, and I think this is a very interesting development for India, and I think India lost the race in manufacturing about 20 years back when the opportunity first presented itself, and China clearly walked ahead of India, as you can see in the share of global merchandise exports between India and China, how the gap has become wider with every passing year over last 20 odd years. And India's exports are comparable to much smaller countries like Vietnam and Thailand. And that is why I say we did not do well in this sphere. Interesting to note that in last few years, the China's share of global merchandise trade is very slowly coming down. I think the reason for that is, as China has become a middle income country, their wages have grown, their compliance with environmental standards has improved. And when we talk to companies now, they tell us that Indian manufacturing is increasingly more competitive versus China in sectors, and that list is increasing steadily. And you can see that Indian wages are much lower than Chinese wages, chart on the right hand side in the middle. And the chart on the middle left hand side is very interesting. It gives the per capita ratio of China to India from 1981 onwards. And it is surprising to note that India's per capita income was higher than China till 1980s, and today there are 5 times our per capita income. The flip side, or the this argument also suggests that we are a cheaper destination to make things now. And I think the recent policy actions by the government suggest that they are very alive and very serious to this very large opportunity. The PLI schemes, the consistent focus on improving our ease of doing business rankings, I think, and the red carpet that we are laying down for inviting foreign companies to India, I think it suggests that we should be able to do better this time around. And I think India has one advantage compared to most of our regional peers. While the cost of manufacturing may be same in India as Thailand or Vietnam, but we have the very big advantage of a very large local economy, a very large local market. And if we use that to our advantage to incentivize setting up of production facilities here, I see no reason why we should not do extremely well. The steps around indigenization of defense production, as you know, India is the world's second largest importer of defense equipment. And if we indigenize that, I think that will again be very positive for manufacturing. So I think this gives us hope that if we are successful in improving our share of global manufacturing, I think it has the potential, this opportunity is so big, it has the potential to improve our GDP growth rates between 1 to 2% per year for quite some time. And I think the association of China with COVID and the disruption in supply chain there, the over dependence of buyers on China, and the challenges caused due to this disruption in supply chain, and the urgent desire to de-risk and to adopt a China plus one strategy, I think is also very supportive of this for India. I think just one last thought, and I feel, I mean, I'm not a, I mean, even though I know a bit of economics, I don't claim to be an expert on this, but this is just too interesting for me not to share. So I think it is commonly understood that if DMs, developed markets, are doing extremely well, if they are growing fast, then emerging markets benefit because their exports to DMs do well. And if you look at these three charts, the top chart is the US household debt to income. And between 98 till 2008, the US household debt levels were increasing. That meant they were spending, borrowing and spending. Now, if you look at the chart in the middle, in the same period between 2000 to 2008, the fiscal deficit in US and Europe also went up very sharply, which again means that you are presenting an opportunity for EMs to export. And if you look at that period, I mean, the last chart at the bottom is the MSCI emerging markets index versus the MSCI world index, which is a developed markets index. And you will see this period coincided exactly with the massive outperformance of EMs versus DMs between 98 till 2010. And what has happened in the last 10 years post GFC, the US households have saved, their savings rate has, debt to income has gone down, fiscal deficit has come down very sharply, and the EMs have underperformed significantly. I think the next few years could be different because, as we all know, post-COVID, the US savings rate has gone up, which means they have ample room to spend with the households in US. The fiscal deficits have gone up very sharply in US and Europe, and they will remain high for a couple of years, even if they taper down. And with this massive underperformance of EMs versus DMs, I think there could be an opportunity, or there is a favorable environment for the emerging markets to outperform. As I said, I am not an expert on these things, and sometimes these things work, sometimes these things don't. And we are mostly focused on understanding the businesses that we invest in and what is the price and what is the value. But I thought this was interesting to share. So once again, thank you very much for making me a part of this prestigious event, and I am happy to answer or discuss any points. Thank you.
Thank you so much. Thank you so much, Prashant. I think that is very comprehensive, and you have touched upon almost every issue that I had in mind and preempted. With every slide, I think you were preempting the questions that I had in mind. But just to touch upon and play back one or two issues that you have talked of. One is that when Sensex scaled 50,000 today, when we went to the market to ask people where do we go from here, there is a lot of caution, a lot of cautious optimism, if I can put it that way. Now, one risk that people are talking about is the normalization that you have also mentioned, normalization of interest rates and normalization of the stimulus and stuff like that, because we had a very bitter experience from the taper tantrum that happened, earlier this decade. Now, you said that will be a risk if they are going come ahead of market expectations, or maybe come at a faster pace than market is expecting. What is it that markets are expecting really?
See, these are very difficult to quantify, and what I have seen is that if you look at, basically this impacts foreign flows, FII flows. If you look at FII flows in India, they've been investing here since 1992. So that's almost 40 years, nearly 40 years. And I think in 37 out of these 40 years, FIIs have been net buyers into India. So, and the years they were not buyers, I think one was the year of sanctions after Pokhran, and one I think was the year of Lehman. So barring these years which had very, events of large magnitude, FIIs have been buyers into India. And I think what I read into that is that India represents a faster growing economy, and the share of global capital flows what we get is extremely small, and therefore over time FIIs have been normally buyers into India. And even, if you go back 15 years, in 2005, the US 10-year yield was 6%. Today it is hard to believe, but it was at 6% US 10-year yields. And even in those times, FII flows into India were positive. So when asked to identify risks, we have to say, and I think it is the right thing to say, that if interest rates globally and if the stimulus globally unwinds at a very fast pace, there could be some, air pockets or markets could correct. But I don't think if cost of capital globally moves up by 1 or 1.5%, it would make things very difficult, because that would be significantly below longer term averages. In my judgment, the best way to look at markets is one to think short term. See, what does 2020 teach us? It teaches us that how tough it is to forecast equities, both on the way down and on the way up. So I think if we start thinking longer term, and if we start focusing on valuations, I think our ability to take a view on the markets improves sharply. And I have seen it time and again that excessively valued markets deliver moderate or below moderate returns over long periods, and markets that are undervalued over time end up delivering above average returns. If you look at these markets, these are close to average valuations. And therefore, my guess would be over 3-5 years, we should expect low or mid double-digit kind of returns. But I would not be able to quantify, which you referred to, as what is the pace, what markets are discounting of unwinding of the monetary and fiscal stimulus.
Next thing, of course, you have touched upon a whole lot of new areas. But when this anti-COVID crisis was going on, and we were trying to anticipate what next, there were certain projections saying that this is going to change the demand patterns in the economy. Are you seeing some kind of changes in the demand patterns in the economy in the early phase of recovery that we are seeing now?
See, I think all of us are still learning. Yes, I mean, some people thought few months earlier, some are, and we are still learning. So, but there are definitely some indications. For example, the income levels at the low income groups have not recovered. And even if you see in US, people earning above $60,000, they have come back, incomes have come back to normalcy, wealth has grown. But in the lower income groups, the unemployment is still high. And that is understandable because both in India and in the West, a large number of low income employment is generated by the services sector, which involves some kind of contact, whether it is eating out or shopping or going on a vacation, travel, tourism, etc. So I think even in India, about 40% people are employed in the services sector, and the income levels at those levels are indeed challenged. Now, right now, we are seeing a surge in demand. How much of this is due to pent up? How much of this is due to very low interest rates, which improves affordability? And there are waiting periods, and some of it is also due to supply chain constraints, logistics constraints. So I think there are a whole lot of issues that are there, and how much of this will normalize and how much will remain due to change of habits remains to be seen. But I do feel, I mean, just one or two observations. When people were confined to their homes, the savings rates have gone up. And now as things are opening, companies are telling us that on the home improvement space, buying consumer durables are seeing a surge in demand because there are savings that have been accumulated over this period. When things normalize, is there a binge of revenge spending, revenge travel, revenge holidaying? I mean, to make up for this period, we really don't know. How much people go back to malls and how much they shift for good to ordering from the comforts of home through e-commerce, again, I think remains to be seen. How fast traffic normalizes, footfalls normalize in multiplexes, in retails, in airlines, because corporate travel, how much of it comes back? I think these are questions on which we have different people have views, but only time will give us the answer.
Prasad, you talked about your expectations for earnings recovery. There's something that we have been waiting for a long time, and you said that probably this is we are realizing probably next few quarters. But then again, you said that this earnings recovery is probably being driven by low cost of capital and of course cost cutting. So how sustainable is this? And once those factors normalize, shall we have a very different picture, because the demand patterns, as you said, are going to change?
See, I think on earnings, we are quite optimistic, and I had a slide in our yearbook. I did not include it here, but let me share with you some information there. So it is true that between 2014 to 20, Nifty earnings growth was very pedestrian. It was just about 4%. Current year, and I think there is high degree of confidence, is around 11%. And between 20 and 23, believe it or not, it is estimated to be more than 20% earnings growth. And I think only the current year earnings growth is driven by cost savings. But let me get into what were the big factors which led to such a low earnings growth in last few years, and where is this optimism coming from? I think the biggest reason for the low earnings growth was the corporate banks, both in public and in private sector. As you know, last few years we have seen a massive or a very big corporate NPA cycle. I think we have firmly come out of it. And over last few days, we saw two pending large resolutions crossing probably the last hurdles also. So I think the provisioning cost of these, and these are balance sheets which are 50-60 lakh crore balance sheets, the top 3-4 corporate banks. So when provisioning comes down, it will have a very big impact on the profits of Nifty. It could be of the order of $4-5 billion dollars per year also. That is, so I think that's one very big number. And I think the banking sector is doing quite well. And I think the results have shown improvement. And I think current year, next year should continue with that trend. I think the another reason in last few years was the provisioning for AGR dues done by the telecom companies. See, even these one-time costs, they impact the aggregate earnings growth. And that is now there in the base. It will not impact profit growth going forward. So that was the second reason. One automobile company had a massive write-off some time back on assets impairment. That is not there. That took away a bit of Nifty earnings growth. Energy companies got impacted by fall in oil prices because inventory losses are there. And now we are moving in the opposite direction. See, rise in commodity prices is very positive for Nifty earnings growth. The consumer companies will pass it on to the consumer, but the commodity companies will report a very sharp improvement in profitability. And I think the final reason is that in our judgment, the US generics market is facing stability in pricing after many years. And many Indian companies have very interesting products to be launched over the next few years. So the pharma sector, which saw a meaningful fall or underperformance in earnings, we think should do quite well over the next few years. So these are some of the reasons why we feel the Nifty earnings growth should be meaningful. See, the cost savings that I referred to, that are pertinent. I mean, they are pertinent to the Nifty also. But please look at the composition of Nifty. The impact of cost savings is not as much there on Nifty. Why do I say that? Because almost a third of Nifty is in banking. And banking, there are not much cost savings to talk about, except NPA provisioning, which is coming down, which is not really linked to this. IT sector is doing well because in COVID, while they have saved some costs, but the need of the businesses to digitize or adjust to the new environment is a real one and a very urgent one. And I think the Indian IT companies have distinguished themselves by performing extremely well in these difficult circumstances. When many vendors, I am told in US and Europe, local vendors did not do as well. So I think the prospects for IT growth are pretty good, which is a 15-17% of Nifty. Pharma we discussed, metal companies, oil companies are benefiting from rise in oil prices, metal prices. And I think one more thing which is happening is that governments across the world, and especially in India, are focused intensely on improving capex. One point which I forgot to mention, one big advantage of India due to the very low cost of capital globally is in the infrastructure space. Look at the activity in the REITs or the foreign capital coming into infra assets, ready infra assets. So what was our cost of debt a few years back? The cost of equity is lower than that today. So infra capex, which needs long-term capital, which needs cheap capital, I think this is the best environment for us to develop that. So the point I'm making is that it looks like capex will revive in India. And if you look at the order backlogs or the order flows of some of the large companies, it is pretty encouraging. If you look at the largest EPC company in India, if you look at their order commentary, the order flows, it has surprised almost everyone. So I think the capex part of if you look at one large multinational engineering company's annual report yesterday, they are optimistic about the changes, about the improvement in capex. So I think capex is also coming back, which should support growth. And finally, I think the FMCG, the consumer sector, it continues to grow at a steady pace. Automobiles, I think, is still, we are not very clear. whether the impact of wages will reduce volume growth. On the other hand, EMIs are extremely low, and there is a keen desire to move away from public transport. So net, it is not very clear, but currently the demand conditions are encouraging even on the automobile spaces.
So Prashant, going back to your slide again, you showed those polarization in valuation, and you have tacitly hinted at reversion to mean. By going by that, are you saying that you would be looking seriously at some of the consumer electricals and metals and power and probably tobacco and those kind of companies going forward?
See, Vijay, I mean, our portfolios have reasonable exposure to sectors that are trading below long-term averages. And what I said is that opinion is sharply divided. Some people believe it's a new world and mean reversion is unlikely to happen. And I, for one, believe that mean reversion should happen. And as I shared with you, some of the thoughts around, thermal power or, I mean, I shared with you my thoughts around that, why I believe the markets are probably mispricing these assets. But I mean, I think the time is the best answer to what ultimately plays out.
Very true. So that also signals that even though you said value investing has given me some pain, but you are still sticking to it, right?
Not some pain, lots of pain.
Okay, Prashant, when you are there, so it's always a plenty of audience questions. I have about 5 minutes. I think I'll have to extend it by another 5 minutes. So let's take a few of the audience questions. I think this is about, again, mutual fund. I think a lot of people follow mutual fund investors, follow you very keenly. You have been managing mutual fund investors' money for the longest time in India. If you were to size up the average equity fund investor, how would you list out some of the behavioral traits or investing psyche? Do you think the Indian mutual fund investor has grown smarter over the last 5-10 years? Or has he become more discretionary?
I think we have come a very, very long way. And I mean, I go back to early 90s and it will take 1 hour to narrate how we used to behave and how we behave now. So I think definitely a large number of Indian investors have understood equities the way it should be. But India is a very large country. If you look at the penetration of equities in India, it is well below global averages. And we still have a long, long way to grow in India. See, in India, even bicycles are selling today. So you have jets. So India is a very vast spectrum. So I don't think we can say generalize. So things have improved considerably, and every year we continue to improve. But I think many investors are still to benefit from a right understanding of equities, and I think over time it will happen. And I think this whole shift towards digitization, making conferences like this possible, will improve access to information, to views throughout the country. And I do hope this leads to a faster and better understanding of equities in India.
Okay. Another question is, selling is key to all sorts of investing. Why does then redemption in by mutual fund investors raise the alarm bells?
See, it does not raise alarm bells. I always say, always focus on the denominator. And most of us, we focus only on the numerator. And I always say, to get a right perspective, don't ignore the denominator. So these redemptions are coming. They are large because the industry has become large. India is a very large market. But if you look at the denominator, we are getting redemptions which are maybe 1-2% of the assets in a month. And these redemptions are there, I think, because when people saw NAVs fall by 30 to 50% over a few weeks, I'm sure some of us were extremely disturbed. And when you see those pre-COVID capital or values come back, you want to de-risk. And so I think I am not, people should, it's their money and they should take, but all I would like to share is that the disturbing trend is that more money comes in at expensive valuations and less money comes in at low valuations. I mean, just think of it, when index was wherever it was 6-9 months back, if we had money, if we thought long term, if we understood equities the right way, we should have doubled our allocation towards that. So my only endeavor is constantly, while people worry too much about timing or security selection, I feel that if you just understand equities the right way, we will make better investors. Some of the best occasions to invest in India have been provided by FII selling. And you can go back and time it. Whether it was Pokhran, whether it was 9/11, whether it was Lehman, tapering, Brexit, for some reason or the other, FII sold. And if you bought around these times, you simply compounded at a faster pace. But unfortunately, what happens to invest in markets that have experienced a sharp fall or continue to fall is emotionally extremely challenging, because human nature is to postpone pain, to avoid pain. And in this process, we end up missing big opportunities. So my advice, suggestion to people always is, when it comes to equities, think long term and focus on valuations and ignore the short term. And whatever you can spare for long term, invest that much in equities. And if you can increase these investments around times of pain in equity markets, I think you will end up more successful investors. And that was the first slide, or one of the few slides, first slide that I wanted to share.
Some 2 years back, you kind of forewarned investors by saying that the good old days of double-digit returns are over in equity funds. That sort of played out over the past 2 years. Of course, thankfully, the COVID months played this severe. But let me ask you, what has really changed? What has made alpha generation more challenging for equity funds?
Nothing, I might have been misunderstood. See, what I have been saying last few years is, see, the inflation levels in general in India have come down. If you go back to 90s, inflation used to be in high single or low double digits. And equities are about broadly giving you returns equal to the nominal GDP growth. And real growth has not accelerated as much as the inflation has fallen. Therefore, the nominal GDP growth in the country, which used to be around 15%, is averaging maybe 12 odd percent in last few years. And that is what I was saying, that if inflation has fallen so much, we cannot expect the good old days of 15 odd percent kind of returns. Coming to alpha generation, what I think the slide I shared on the concentrated movements of the market, that is pertinent. When 5 stocks out of 50 Nifty deliver 80 or more than 100% returns, for a diversified manager, it becomes more challenging. And that is what has happened to many mutual funds. And there are a few funds who have managed to beat even in these markets, driven by some very good individual selections that they have done. But many mutual funds have struggled to generate alpha. And this was the key reason. I don't think these markets will forever behave like this, because over time markets become broad based, and these are phases, as you can go back and see in the same chart. So as markets become more broad based, I think the outperformance should come back. And the second reason I said outperformance has become difficult is because the total returns of the indices have come down. As I shared, the last 10-15 year returns of the index itself have been around 10 odd percent roughly. And the fund expenses as a percentage of the 10% returns are a higher obstacle to cross than the fund expenses in relation to a 15% return. So the lower overall returns have also made life difficult for managers. And let's see how people like me are able to do in the future.
This question comes in from the US, saying whenever you think of investing thesis on India, some or other kind of disruption comes in, or some kind of a policy uncertainty looms over it, and you can't really build conviction. How do you build conviction on a thesis amid those policy uncertainty, disruption, and the many important variables that India is known for?
See, I mean, this is partly right, and I would say, see, it is, I mean, I don't know this person, but I am guessing, see, it is a human trait that people want to invest. They feel more comfortable investing when everything is good, when uncertainty is less. But if you invest when there is limited uncertainty, chances are assets are priced to perfection. And that is why most of the money in equities comes in a very good environment. And so I think Warren Buffett has said that, something to this effect that uncertainty or volatility, it can be used to our advantage.
He's your friend. Yes.
And I would agree that there have been few, policy direction in India has changed once in a while. But I would say, look at India not year to year. Look at India every 5 years or 10 years. And if you look at the India of 1990, if you look at the India of 2000, if you look at the India of 2010, and if you look at the India of 2020, every 10 years the country has decisively moved forward. In between, it is very noisy. The coal scam took so many years. The telecom sector took so many years to figure out. Now, IBC cases have taken a fairly long time to clear out. This NPMS has taken probably good 8-10 years to clear out. So India typically goes through a few iterations before we get things right. And another point about India is that we change the maximum in periods of crisis. And every big reform in India, most of the big reforms in India took place around crisis. So I jokingly say that every crisis is welcome in India. So I would agree partly with that, but I would say that it is no reason not to invest in India, because despite all these challenges, if you look at the journey of Sensex from 100 to 50,000 over 40 years, it has been a very profitable journey. It has had its highs and lows, and India is a democracy. It is a federal structure. It has a free media, free judiciary. So there are challenges. Change is always difficult in this complex country. But I think the broad direction of India is right, in my opinion. And in this period of COVID, we have carried out some very encouraging reforms. And I don't want to take this time, but I am quite encouraged by what we have achieved in the last year or so.
Yeah, Prashant, we have, I think I have already stressed it by 5 minutes or so, but there are 3 quick fire questions by someone who calls you her icon. So one is, which are the books you always keep close to you and turn to often?
See, I don't read the same book again and again, but I think one book, 2 books that I would recommend is, one is Psychology of Investing or Psychology of Money by Morgan Housel. And I think my thinking matches 90-95% with that book. I think it's a very good book for everyone to read.
Prashant, I'm sorry to interrupt. I think we missed the first part.
The Psychology of Money by Morgan Housel.
Okay, great.
I think it's a book which everyone should read. It talks about the role of money, how to look at money, how to invest, and how to have a good balanced life. I think it's a really good book and very, very readable. One more book which I would recommend to everyone would be, it's by Peter Bevlin. It's on Warren Buffett and Charlie Munger. The name of the book is All I Want to Know Where I Am Going to Die, so that I never go there. It's a very interesting book, and it again teaches us a lot about investing and life. And so I think these are 2 books that I would recommend.
Okay, you have already referred to Warren Buffett and Munger twice, I think. who is the investing great who would have left an indelible impression on your minds, and why?
See, I have benefited from lots and lots of people, and that is the honest answer. And I try and learn from everyone I meet or everyone I connect with. And it would be difficult for me, and that would include many current ex-colleagues in the company, in the industry. But specifically, I would like to mention I have benefited a lot by reading few books about Mr. Buffett, Charlie Munger. I have benefited a lot. I enjoy reading Howard Marks a lot. And there is one very good book which also I would add to that list. It is The Most Important Thing. It will take 2 hours to read by Howard Marks. I think that's again a very good book. So I think these are 2 or 3 people whom I have benefited immensely from. Morgan Housel is good. So as I said, it's a long list and I try and learn from everyone and without people realizing, but I do tend to pick up things by observing and listening to people carefully.
Wonderful. So one last thing. What do you do when you fail to take a decision, but yet you have to decide?
When I fail to take a decision, but have to decide.
Yes.
You sleep over it, and sometimes by the time you get up, you have the answer.
You have a solution. Thank you so much. It's always a great pleasure talking to you. And the conversation never really ends. But I have to wrap it here. Thank you for giving us your time and sharing those insights and for leaving us thinking in new dimensions. I'd look.
Sure, Bijoy, and thank you, ET, for giving me this opportunity and wish you all a great year ahead. Thank you.
Thank you so much, Prashant, and thank you so much, Bijoy, for joining him for this insightful discussion, as well as the recommendations, Prashant. Thank you so much. Moving on, I would like to thank all the eminent speakers who spared their valuable time and shared some solid thoughts in today's session at the ETMarkets Global Summit 2021. We would like to thank our mutual fund partner, ICICI Prudential Mutual Fund, our associate partner, StockWits, and securities partner, IIFL Securities. We also express our sincere gratitude to everyone who joined us today. We hope that there was plenty of wisdom and ideas for you to all take home. Do remember to log in tomorrow for the third day's session where we will have India's youngest female fund manager, quizzing Dalal Street veteran Ramdev Agarwal, and then there will be sessions on international investing and separate sessions on cyclicals as well as mid caps. Thank you and see you tomorrow.